Hello, students. Good evening to all. So, today we are discussing a very important topic assessment procedure. It's chapter 15 of ICAI module. And if you ask me from exam point of view, almost 8, 6 to 8 marks of paper come from this chapter in every attempt. So, my chapter is assessment procedure. This chapter is basically we can divide this chapter majorly into two or three headings. First one it contains return of income, the provision related to return of income. We will discuss each one of them in great detail. Then assessment procedures, the different types of assessments, and then the miscellaneous one. Today we'll focus on the first thing, return of income. Return of income. So from exam point of view, around 6 to 8 marks of paper comes from this chapter in every attempt. And more so from practical point of view, I can tell you that this will be the most important chapter in the when we start the practice of income tax, when we do the income tax practice. This is the most important chapter which comes to our use. This is because everything starts with the return of income. What is the return of income? Sir, we know a lot about return of income. We have filed hundreds of return of income in our articleship period. Let me try. See, return of income is the why I'm saying it's a very important chapter is because return of income is the first communication between an SSC and the department. So, and this is the first and the base communication. This forms the base for all the proceedings. What happens in let me briefly discuss what's the procedure which happens in the case of income tax. So, firstly, an SSC files return of income. This return of income may or may not. This return of income may be scrutinized, may come into the assessment, and in assessment, there may be a demand, there may not be a demand. If there's a demand, then the appeal route starts. So, this is the whole journey of a year in the income tax. So today we will discuss the return of income. Tomorrow we may discuss the assessment procedure, and subsequently we will study appeal procedure as well. In chapter 50, there is no appeal, only the return and the assessment. Okay. So what is return of income? Return of income nothing but a statement of computation of a total income and tax liability. There will be some students who may have done the articleship in purely in audit. So they may not be very familiar with the return of form or return of income. But let me tell you, there's no rocket science. It's just a statement of computation of total income, like we do in our quotient. We compute headwise income under salary, house property, PGBP, capital gain, other source. So similarly, there's a form which provides computation mechanism in all these heads of income. Then comes the curbing and set of provision. Then comes the deduction. And finally, we come to the taxable income or the total income. And then comes the computation of tax liability. We apply the tax rates on the total income and the tax liability is determined. From this tax liability, I deduct TDS, TCS on all taxes which we have paid, all the credits like MAT credit and all. And the remaining amount is called the tax payable, which is self-assessment tax. This is, I have just very briefly gone with you the whole process, and we'll discuss each one of them in very detail, in a lot of detail. So what I told you, return of income is nothing but a statement of computation of total income and computation of tax liability. But what government does is, in addition to all this, government wants some information which helps the government to check the genuinity of your claim, to check the genuineness of of the return you have furnished, of the income you have disclosed. So in return income, in addition to the income and tax, there is some other information like information related to foreign assets and bank account, etc. So, so firstly, we will discuss the section 139. There are different types of return. All are taken care by section 139. So my section 139(1), it provides two things. One, who is required to file the return? Who is required to file the return? And second, what is the due date? The due date to file return of income. So we all know there is a year concept in income tax. Income tax follows the year concept. We have to compute the tax liability for each year. I cannot say that I want to pay the tax for the 5 year at one go. No. The income tax follows the year concept, and by year it means financial year. Year starting from 1st April to 31st March. So what happens is that I earn income during the previous year and I file my return subsequent to the previous year, which is called assessment. So let's first see who are all persons who are required to furnish return of income. So my section 139(1) says every company or a firm is required to file return of income in all cases. So whether they have an income or not, yeah, even if they have no income, still they are required to file return of income. If there is no transaction during the entire year, still they are required to file the return of income. Even if the company is incorporated on, say, 31st March 2026, still that company is required to file the return of income of the previous year, 25-26. Because company and firm are required in all cases to file return of income. There is no condition. If there is a company, if there is a firm, so they have to file return of income every year. Whether there is an income or not, whether there is any transaction or not, everything is irrelevant. A company or firm is required to file return of income in all cases. Okay. We know LLP, firm includes LLP. So when I say firm, it means LLP is also required to furnish return of income in all cases. Okay. Income Tax Act. In Income Tax Act, the firm and LLP are considered equally, except in section 44 AD and ADA. Otherwise, for the entire act, whenever we use the word firm, it includes LLP as well. So you are with me? In case of company and in case of firm, there is a requirement to file return of income in all cases, whether there is an income, there is a transaction, or irrelevant. If you are a company or a firm, you have to file return of income for all the years. Okay. Then, for the time being, keep it on a hold, these points. Then 139(1) says that in case of other persons, persons other than the company or the firm. So we are talking about individual, HUF, AOP, BOI, artificial juridical person, corporate secretary, or any other person other than the company or firm. They are required to furnish a return of income only if their income exceeds the basic assumption limit. So when they are required to furnish the return of income, when their income exceeds the basic assumption limit. Now, what is the basic assumption limit? If I say for individual, if you opt for the old regime, then the basic assumption limit is 3.5 lakh. If the age of the individual is up to 60, less than 60 years. If the age of the individual is 60 or more, then it's 3 lakh. And if it is of 80 years or more, then it's 5 lakh. So if my income exceeds this limit, as the case may be, then I am required to furnish return of income. Or if I am going for the new regime, then my basic assumption limit is 4 lakh. So as the case may be, whether I am opting for new or old, and if I am opting for old, what is my age? Depending upon that, the requirement to file return of income is ascertained. So if my income exceeds the basic assumption limit, then I am required to furnish return of income. If my income is less than the basic assumption limit, then I am not required to furnish return of income. But the story doesn't end here. The other story starts from here. The income. When I say income, I mean income. I don't mean total income. I mean total income without giving effect to Chapter 6A. What is Chapter 6A? Chapter 6A are the deductions. So I am saying I have to see the income without giving effect to chapter 6. I have to compare my income with the basic assumption rate. Which income? The income without giving effect to chapter 6A. Means this, if I ask you what I call this phrase, total income without giving effect to chapter 6A, I call it gross total income first. So this is called gross total income. What happens? Actually, what is gross total income? It's nothing. It's the aggregation of the income under all the heads. And after set of hand clubbing, I got a gross total income. From GTI, I reduce my chapter 6 deduction. I get the TI on which I apply the tax rate.
What is this size?
Sorry? Any query? Ashok ji? Hello?
Hello? Waiting
Yes,
for
sir.
your input.
Amit Kumar, please. अशोक जी,
Can I carry forward?
ये एक स्टूडेंट अपना वीडियो ऑन रखा है.
Okay, let's continue. So, I was saying, how the income tax is computed. So, I have all heads of income. Then, aggregation of all these heads plus clubbing minus set off gives me the GTI. I reduce deduction and I get the TI. This is the total income, taxable income on which I apply the tax rate. So, whether I'm required to file return of income or not, I need not to see the TI. Remember, I have to see the GTI. So, if GTI exceeds the basic assumption limit, then I am required to file the return of income. So, what they are doing, what the government is doing, government is exceeding, is enlarging, is increasing the scope, is increasing the base, is enlarging the number of people who can file the return of income. Of course, you understand now? There will be lesser people if TI has to be compared with BL. But I have to see the GTI before deduction. If my GTI exceeds the basic assumption limit, I have to file the return of income. Not only that, I tell you, I told you the stories only have started. I need not to see even the GTI. The law says you have to add all exemptions under section 54 series. So under the capital gain head, I have 54, 54B, 54D, 54EC, 54F. All these are exemptions from the capital gain. So I have to see my income before these exemptions. So what I'll do, I compute GTI, then I add all these exemptions and the amount which we come around, which is arrived. I have to compare it with the basic assumption limit. If this amount exceeds the basic assumption limit, then there is a requirement to file the return of income. Understood, friends? So what I say is that any other person, if total income, any other person in respect of which he is assessable, I'll come on this in a minute, exceed the basic assumption. So for any other person, where is the requirement? If his total income exceeds the basic assumption limit. And what is the total income? The above total income is to be computed without giving effect to the provision of chapter 6A. What I call this line, total income without giving effect to the provision of chapter 6A. This is called, friends, GTI. So I have to see GTI, not only GTI. I have, without giving effect to the provision of exemptions under section 54 series, the capital gain series. If this amount, if my GTI plus 54 exemption amount exceed my basic exemption limit, then I am required to file the return of income. So we are very clear. In case of company and a firm, there is a mandatory requirement to file return of income, irrespective of the nature of income, irrespective of the amount of income, irrespective of the transaction. And for any other person, I am required to file return of income if my GTI, excluding the 54 series exemption under 54 series, exceeds the basic exemption limit. Basic exemption limit may differ depending upon the assessee. If he is opting for the new regime, then basic exemption is 4 lakh. If he is opting for the old regime, then the basic exemption can be 2.5 lakh, 3 lakh, or 5 lakh, as the case may be, depending upon his age and residential status. We know all that. Okay. So, can you tell me why government is comparing GTI and also not giving the benefit of exemption while deciding whether I'm required to file return of income or not. I mean to say, why government is not comparing on the total income? The reason is very clear. These deductions, these exemptions, the section 54 and all, are of maybe of substantial amount. So government actually wants to see whether you comply with the condition of this section in which you have claimed the exemption. See, I told you, return of income is the first step where the assessee and the department and the government meets. So government doesn't want to limit that exposure. Government wants कि more and more information should come to me so that I can at least check whether they comply with the condition or not. So they are increasing the base. And okay. So story again has not yet ended. It's only started. The law further says कि even for the assessee whose GTI plus the 54 exemption is less than the basic exemption limit, still they are required to file the return of income. Yes. If your GTI and the section 54 exemption is less than the basic exemption limit, still you are required to file the return of income if you satisfy any of these four clauses. What are these four clauses? Firstly, if you have deposited, and you by me, assessee, if assessee has deposited an aggregate amount exceeding rupees 1 crore in current account maintained with a banking company or cooperative bank. If there is a deposit of 1 crore, if the deposit of more than 1 crore in the current account of an assessee, then he is required to furnish return of income even if his income is less than the basic exemption limit. Okay. What does it say? Deposit an aggregated amount exceeding 1 crore in current account maintained with a banking company. So the amount has to be aggregated. We have to aggregate all deposit in current account in a financial year. If that amount exceeds 1 crore, then there is a requirement to file the return of income, even if the income is less than the basic exemption limit. We are repeating this so many times so that it gets into your mind and you remember it. It helps you in remembering. It said the deposit should exceed 1 crore, not the 1 crore. It said exceed 1 crore in current account or accounts maintained with a banking company. So take an example. I have a current account with SBI, right? I have a current account with ICAI. I deposit 75 lakh here in my current account. I deposit 75 lakh here. The total deposit is 1.5 crore, but I have to see per bank in a banking company. In each bank, there is a deposit of less than 1 crore, and therefore, I am not coming under this clause. You see? Yes, Geeta ma'am. If an assessee has more than one current account in a bank, then all has to be taken. Okay. So I have to aggregate all current accounts in one bank. But if I have multiple current accounts in multiple banks, then I need not to aggregate all this. I have to go bank wise in a current account. One more thing. If you see, it says, wait. It says here deposit aggregate amount exceeding 1 crore. No, there is nothing where it is written. There has to be cash deposit. So there has to be a deposit. Even if there is a transfer from one current account to another current account and the amount exceeds 1 crore, the requirement comes in. Okay. So we'll do everything in much detail, so that it helps you in remembering. Similar provision is for the saving bank account. The last one, if you see the D part, he has deposited aggregate amount exceeding 50 lakh or more in saving account. So similarly, you have to see all saving accounts in our bank. If the aggregate during the financial year exceeds 50 lakh or more, here see the difference, the minute difference. Here the word is exceeding 1 crore in case of current account, but in case saving account, it is 50 lakh or more. So even if the aggregate deposit is 50 lakh, there is a requirement to file the return of income. I hope you are with me. Do ask me, keep the session interactive. Any question, even the smallest one, and even the latest one, ask me. I'll be happy to answer. Okay. So even if the income does not exceed the basic exemption limit, there is a requirement to file the return of income if the deposit in current account exceeds 1 crore or deposit in saving account is 50 lakh or more. Then next condition is if the assessee has incurred an aggregate expenditure exceeding 2 lakh for himself or any other person for travel to a foreign country. So if I have incurred an expenditure on foreign travel of rupees more than 2 lakh, then I am required to furnish return of income. Okay. The point says, the clause says that I must have incurred the expenditure on foreign travel. It's not necessary that I myself undertake the foreign journey. Okay. I may have incurred an expenditure for my relative, for anybody, but if I have incurred the expenditure on foreign travel, then I am required. The journey is not important. The person who is incurring the expenditure is required to furnish the return of income. Okay. And one more thing, the expenditure should exceed again rupees 2 lakh. Then thirdly, he has incurred an aggregate expenditure exceeding 1 lakh towards electricity consumption. Okay. So if I incurred and I have paid electricity bill of more than 1 lakh during the entire financial year, then I am required to furnish return of income. The bill may be for the residence or for my office, whatever. If I have paid the bill of more than 1 lakh towards the electricity consumption, then I'm required to furnish return of income. Okay. Then comes if I'm into the business and my gross receipts is more than 60 lakh, or if I'm into a profession and my gross receipts is more than 10 lakh, then also I'm required to furnish return of income. And lastly, if the aggregate of TDS and TCS, if the aggregate of TDS means the tax deducted on my income. If somebody has deducted my TDS or somebody has collected TCS from me, if the aggregate of these two amount is 25,000 or more, or in case of senior citizen, if I'm a senior citizen, it is 50,000, then also I am required to furnish return of income. Okay. I hope I'm clear. These are the requirements when even if your income, even if the income of the self is less than the basic exemption limit, still he is required to furnish return of income. When if the deposit in current account exceeds 1 crore, deposit in saving account is 50 lakh or more, he has incurred expenditure of 2 lakh on foreign travel, he has incurred expenditure of more than 1 lakh on electricity consumption, he is into the business, the gross receipt exceeds 60 lakh. If he is into the profession, the gross receipt exceeds 10 lakh, and the aggregate of TDS and TDS is 25,000 or more. If you see minutely, only in the last two clauses there is 25,000 or more, 50 lakh or more. In all the above clauses, it's exceeding. So if the amount deposit exceeds 1 crore, expenditure exceed 2 lakh or 1 lakh, as the case may be, so it helps you in remembering. It only in the last 2 points, it is the amount or more, 25,000 or more, the aggregate of TDS or TCS, and the deposit saving account is 50 lakh or more. Why government is making it so complex? The complexity will only increase in a minute, but we will do slowly and we'll do everything with understanding. Why government is making it complex? See, I'll tell you, the Honorable Mr. Arun Jaitley, he was the Finance Minister of India. At the time when he was presenting a budget, I think somewhere around 2014 or 15, on the floor of the parliament, he said that India is basically a country of a non-compliant. What does it mean? He said that we have a data of people who are traveling outside India, who are making foreign visits, but they are not filing return of income. By not filing return of income, he means that the income of the assessee is less than the basic exemption limit, 2.5 lakh. And a person having an income less than 2.5 lakh is able to afford a foreign trip. This doesn't gel with the logic. There is something non-compliant. So if you see in all these cases, it is hard to believe that you have deposit more than 1 crore in current account, you have deposit 50 lakh or more in saving account, you incur 2 lakh on a foreign trip, but you have an income, taxable income of less than 2.5 lakh. It creates a doubt in the mind of the government. So government wants to check. You file the return, let me check. You have income and expenditure of more than 2 lakh foreign travel, and you're saying your income is less than 2.5 lakh, let me check. So this is to increase the base. And government doesn't feel something is logical in all this. Okay. What we have studied, for company and firm, there is mandatory requirement to file return of income. In case of any other person, the requirement applies only if the GTI, without giving effect to the Section 54 exemption, exceeds the basic exemption limit. But still, even if I don't come into this clause, if my GTI is less than the basic exemption limit, still I may be required to file a return of income if I satisfy all these 7 points, either of the 7 points. Any of them. Story is continuing. See, government say there may be a situation even if now you are not required to furnish return of income, means your income is less than the basic exemption limit and you are not coming under these 7 points. Still, if you are resident and ordinary resident, then you may be required to furnish return of income if you have any asset outside India. So what happens is, students, one of my friends, what happens is that what people do is that you must have heard about Swiss accounts and all. They illegally transfer their money from India to outside India and earn income outside India and doesn't disclose it. Doesn't pay the tax to the Indian government. They being a resident, they are required to pay the tax on their global income, but they don't pay the tax on their foreign asset because they don't disclose it. Because they have transferred the money illegally to outside India. So to curb this, what the BJP government did is in 2015 they came up with the Black Money Act. Black Money Act basically majorly deals with the, I think it's primarily deal with the, not basically, it's primarily deal with the foreign assets, undisclosed foreign assets. If you have assets in foreign country which is undisclosed means you cannot explain the source of such foreign asset, then Black Money Act levies penalty, tax, interest and all on it. Okay. So question comes, where is the need to disclose foreign assets? I don't have an income exceeding basic exemption limit. I don't come under all these 7 clauses. So how can you say that? My foreign asset undisclosed? So they came up with the requirement that if you are resident, ordinary resident, and you are the beneficial owner or otherwise means the registered owner, legal owner of any asset located outside India, or you are a beneficiary of any asset. We'll discuss each of this in a detail in a minute. Or you are signing authority in any bank located outside India. Then even if you are not coming under any of the clause, you are still required to furnish return of income. So what I am saying is that if there is a person who is resident and ordinary resident, it applies only to the ROR. Why? I'll discuss in a minute. If you know why, then you can share in the comment. So if you are a resident, ordinary resident, and you either is the beneficiary owner or actual owner of an asset located outside India, or you are a beneficiary of any asset located outside India, or you are a signing authority of any bank account located outside India. Either of these things. If you come either of under these 3 clauses, then you are still required to furnish return of income. Okay. So firstly, why this requirement is only on the ROR? See, of course, if they put it for the RNOR or NR, it becomes very weird because they of course had an asset outside India. They need not to, they have an income outside India, so they need not to disclose it to the Indian government because such income is not even taxable in India. We'll know that. So that's the reason they have said this clause applies only to the ROR. Okay. So what it says that if a person who is ROR is a beneficial owner of any asset outside India, the any asset includes any financial interest. Financial interest means either you are a partner of a foreign partnership firm, you have a share in a foreign company, you have a debenture of a foreign company. So you have a financial interest in the entity outside India. So you have an asset outside India and you are required to furnish return of income, provided you are ROR. Okay. Who is the beneficial one? beneficial owner is the one who has provided directly or indirectly consideration for asset for the immediate or future benefit, direct or indirect for himself or any other person. Who is the beneficial owner? Beneficial owner is the person who has actually paid the consideration, whether for acquiring the asset. Whether the asset is for his benefit or benefit of any other person is not relevant. The person who has paid the consideration is the beneficial owner. Okay, so you have to remember who has paid the consideration. If Mr. A has paid the consideration, then he is the beneficial owner. Okay. Then comes whether the requirement is even if you are not beneficial owner, but if you are beneficiary of any asset located outside India, then also required to furnish return of income. Now, what is the difference between beneficiary owner and beneficiary? Who is beneficiary? Beneficiary is the who gets the benefit of such asset. He may have incurred the cost for such asset. He may not have incurred the cost of such asset. What is the beneficiary? I purchase an asset in the name of my son. Okay, so I am the beneficial owner and my son is the beneficiary because he's getting the benefit from the asset. Or if I have a signing authority in any bank outside India, still I am required to furnish return of income. Okay. So whether I am a beneficial owner or a beneficiary or have a signing authority in any bank outside India, I am required to furnish return of income. Either of these three. This is the last clause. So don't worry. This is 139.1. So who all are required to furnish return of income? Company firm in all cases. Any other person if the income exceeds the basic exemption limit, or he comes under those 7 clauses: the deposit in current account, saving account, expenditure, foreign travel, electric consumption, and then the turnover in the business profession, and lastly, the aggregate of TDS and TCs. Okay. I'm repeating this just so that it gets into your mind. Lastly, if a person who is ROR is also required to furnish return of income, either is a beneficial owner or a beneficiary or is a signing authority in any. Now, let's dive a little deep into this. The provision says any person, any person, being resident other than not ordinary residents, means ROI, who is not required to furnish ROI as above, return of income, shall furnish the return of income if at any time during the previous year. So this provision applies even if you had an asset for a small part of the year, still you're required to furnish a return of income. At any time, if you were the beneficial owner of the asset for any time during the previous year. If you had the share of Microsoft US, Microsoft Inc., even for a week, then for that year, you're required to furnish return of income under this clause. Okay. But section applies to any person. So the person may be individual, HF, anybody, but he has to be ROR. But if you come towards the end, towards the definition of beneficial owner and beneficiary, they say that beneficial owner means an individual. Beneficiary means an individual who derives the benefit. So in the definition, they have restricted the definition to only individual. Okay. So the interpretation rule comes, though my main provision applies to all persons, but it applies to who? Who is a beneficial owner? And who can be the beneficial owner? Beneficial owner can only be an individual. Who can be the beneficiary? Beneficiary can only be an individual. So therefore, this section, this clause applies only to an individual who is ROA, who is a beneficial owner or beneficiary of the other. Understood? A small interpretation issue. Lastly, this provides an exemption. See, what happens is that there are people in India who have a good income. The startup promoter, you take the example of Zomato promoter, Swiggy promoter, and they have a good income. What they do? They earn income in India, they pay due taxes, whatever dues to them, and then they invest this money, a part of this money, into foreign assets in the name of their family members, maybe their spouse or their children. Okay. So take an example. There's Mr. A who invests rupees 10 crore in a property in the name of Mrs. H. And this is fairly disclosed, all comply with all legal formalities. Now, in this case, Mr. A is a beneficial owner because he has paid the consideration, and Mrs. A is the beneficiary of this property. Right? Till now, we have studied is that Mr. A and Mr. B both are required to furnish return of income. Mr. A because he is a beneficial owner of an asset located outside India, and Mrs. A because she's a beneficiary of an asset located outside India. But Act says, if you know, the income from this asset shall be clubbed with the income of Mr. A under section 64. Clubbing process shall apply. So Act says, if this is the case where the income of an asset is to be clubbed with the income of the beneficial owner, then in such case, beneficiary is not required to furnish return of income. Because there is no risk of tax evasion. Because this income is by itself is getting clubbed with the income of the beneficial owner. Understood? What this is say? It says, however, an individual referred to in clause B, beneficiary, is not required to file ROI if income from such asset is includable in the income of person referred to in clause A above. So, if beneficiary, the law exempts beneficiary from the requirement of filing ROI if the income from such asset is includable in the income of person referred to A above, and the person referred to above is the beneficial owner who is otherwise also filing return of income as a beneficiary. Okay. Sorry. Is there any doubt? Am I clear? Any doubt? Do ask if you have any doubt. Okay. So what we have studied? We have studied the requirement of filing return of income. This is complete. Where it says that every company and a firm is required to furnish return of income. Then any other person whose income exceeds the basic exemption limit. Then any other person, even if his income is less than the basic exemption limit, if it satisfies all those 7 conditions. And lastly, an individual who is ROR, he is either a beneficial owner or a beneficiary or a signing is a signing authority in any bank located outside India. Then he is required to furnish return of income. Only one exemption is there. The beneficiary is not required if the income from the assets is includable in the hands of beneficial owner. So we discussed this in 30, 45, 40 minutes, but we revised it in only 1 or 2 minutes. I have given a small chart on left hand side to revise it. So just it's good for your eyes. You retain it. Requirement file ITR for a firm or company in all cases done for any other person. If it's total income, which total income? Total income excluding deduction of chapter 6A means GTI and exemption in the section 54 series to be considered. Okay? If total income exceeds basic exemption limit, BEL matlab basic exemption limit. I told you it may differ depending upon the assessee. Then if we satisfy this or in all between, if you satisfy even one of the conditions, you are required to furnish return of income. If you satisfy in any of these conditions, then you are required to furnish return of income. What are the conditions? The aggregate deposit in current account exceed 1 lakh. It never says cash deposits. The deposit should exceed 1 lakh. Aggregate deposit in saving account is 50 lakh or more. I told you there's only 2 clauses where there is or more. Saving account and TDS and TCS aggregate 50K or 25K. Then the 2 clauses are there in respect to expenditure. If the expenditure of foreign travel exceeds 2 lakh or expenditure on electricity consumption exceeds 1 lakh. Then 2 clauses on turnover. Turnover in business exceeds 60 lakh. Profession exceeds 10. So if I satisfy either of any of these conditions, then I am required to furnish return of income. Lastly, if I am the actual owner or the beneficial owner or beneficiary or signing authority in any bank, then also I am required to furnish return of income. So 139(1) creates an obligation. Who all are required to furnish return of income. Subsequently, we will study if you don't comply with this obligation, there are penal clauses which will attract. We'll study today only. Okay. Any question till now? Happy to take. No worries.
सर एक क्वेरी है सर.
Yes, sir.
सर करंट अकाउंट में आपने बताया कि ये एवरी बैंक के वाइज देखना चाहिए कि जैसे एसबीआई है, आईसीआईसीआई है, अलग अलग. फॉर सेविंग्स अकाउंट के लिए भी बैंक वाइज है या फिर टोटल सब
Again,
बैंक
similar, same thing, sir. As in current account, bank wise.
लाइकवाइज सर. ओके सर, थैंक यू सर.
I think my notes are not properly visible. You know, I read increase the font. So okay. Actually, this happened because I'm showing two screens at a time. I'll do it one single. It maybe. I hope it's visible now. Okay. Now the second topic. It's about due date. One 131 says who all are required to furnish return on income, which we just studied. Now we are coming to when we are required to furnish return of income. When the return of income is required to be furnished. As I told you, in income tax, we follow the yearly concept. We file a return of income for a year. Okay. So, thanks, Neha. So, for every year, there is a requirement to furnish return of income. I told you, we follow in income tax, there is a concept of previous year and assessment year. Assessee earns income in a previous year and it pays tax and files the return of income in the subsequent year, in the assessment year. Okay. So my due date for final return of income is the assessment year. For my exam, my previous year is 25-26. So these due dates are 31st October 26. My assessment is 26-27, 30th November 26, and 31st July 26. I'll discuss this in detail. What all are these? So basically, you got an idea. There are 3 due dates for different type of assessing. 31st October, 30th November, and 31st July. Okay, you understand 31st July. We keep on using this in IPCC, in articleship and all. So what the government says is that government has given more time to the person who requires more time, whose accounts are complex, who require more time for preparing the return. So what is the law? It says that every company, the due date is 31st October. And for other person, the due date 31st October, if their accounts are required to be audited under this Act or under any. Okay. If my accounts are required to be audited under this Act, which section requires me to get the accounts audited? It's section 44AB, tax audit. If my accounts are required to be audited in the Income Tax Act, or even under any other law, maybe the LLP law or any other law, then my due date filing return of income is 31st October of the assessment year. I'm with you? See, I am a partnership firm and my accounts are required to be audited. So due date for me for a partnership firm is 31st October. Clear? But there's a section 40B. 40B says that gives a limit on allowability of the remuneration interest which a partnership firm gives to its partner. And whatever interest or salary is allowed to the partnership firm, it's only such amount. To that amount only is taxable in the hands of partner. Okay. So if the partnership firm, assuming this partnership firm ABC and Associates, it gives a salary of rupees 10 lakh to its partner. But under section 40B, by applying the limit provided under section 40B, the salary allowed to the firm is only say rupees 8 lakh. 2 lakh rupees is disallowed in the hands of the firm. Then in the hands of the partner, only 8 lakh shall be taxable. Not that though he has received 10 lakh, but only 8 lakh shall be taxable, and we have all studied this in PGBP. Okay. But question comes, if my accounts, the accounts of the firm is required to be audited, then my due date 31st October. And this amount, 8 lakh, shall be freeze only close to 31st October. So if due date has been extended for the partnership firm, then it has to be extended for the partner as well. Because this 8 lakh has to be taxed in the return of the partner. And partner would not be able to ascertain, to identify this amount unless the accounts of the firm are finalized. Because this 8 lakh is dependent upon the book profit of the firm, which gets finalized in the audit. So, because the due date of firm has extended, so they have to extend the due date of partner as well. So, a partner of a firm whose accounts are required to be audited under this act or any other. So, if I'm a partner of a firm whose accounts are required to be audited, then the due date for the firm is 31st October and due date for me is also 31st October. I told you firm includes LLP as well. So, I may be a partner of a firm or an LLP. If the accounts of such firm or LLP is required to be audited, then due date for me as well is 31st October. You understood the reason why? Okay. Then here comes due date for me is 31st October, but the law says even for the spouse of a such partner, if provision section 5 applies to such spouse. So it says for the firm whose accounts are audited, due date is 31st October. Then for the partner of the firm, due date is 31st October. Understood. Not only this, even for the spouse of this partner, due date is 31st October. But when they are governed by section 5A. What is section 5A? Can anybody tell? Okay. Geeta is asking if a partner has total income less than basic assumption limit, then his due date. Okay. See, what we have studied till now is that if he's a, what took is that? Perfect. I'll come to, she's saying about the 5A. Yeah. The question is, if partner has an income less than the basic assumption limit, what is the due date? So, what we have studied till now is that if he's a partner of a firm whose accounts are required to be audited, then due date 31st October, irrespective of the income of the partner. Then we will not see whether his income is basic assumption, exceed basic assumption limit, less than basic assumption limit. If he is a partner of a firm whose accounts are required to be audited, then his due date is 31st October. Okay. A question should come from your side is that we understood why the limit has been increased for the partner. What I told you, because the income of the partner depended upon the finalization of accounts of the partnership firm. And therefore, if the due date for partnership is 31st October, it has to be 31st October for the partner. But you must ask is that the income of only working partner is dependent upon the income of the partnership firm. See, section 40B, if I revise you, talks about two things. Interest, which a partner is getting from a partnership firm, and salary, which a partner is getting from a partnership firm. It says interest is allowed only 12% to the partnership firm. So if a partnership firm is paying an interest of 15%, only 12% shall be allowed to the partnership firm as a deduction. And similarly, only 12% shall be taxable in my hand as a partner of such partnership firm. Okay. So for this 12%, I need not to wait for the finalization of account of the partnership firm. This amount is certain. This is not dependent upon anything. And if the interest is 15%, I will offer only 12% my return of income. Am I clear? For salary, Act says there are two types of partner, working partner and non-working partner. Okay. In respect to non-working partner, the any salary paid to non-working partner is not allowed. So any salary received by the non-working partner is not taxable in his hands because the firm has not made out deduction. So irrespective of the income of the firm, if I'm a non-working partner, any salary I receive from the firm is not taxable in my hands. Again, I'm not depending upon the profit of the firm. So only working partner who is getting a salary from the firm is depending upon the finalization of accounts of the firm. So ideally, only in case of working partner should have increased, but to keep the things easy so that Government always takes care of CA students. You don't feel difficulty in remembering things, so it doesn't confuse you. If you're a partner, whether working, non-working, don't apply your mind. If you're a partner, then of a firm whose accounts are required to be audited, then your date is 31st October. Clear? Okay. Before discussing section 5A, I'll discuss one more thing. The law says a person whose accounts are required to be audited. So it should not be a case that your accounts are not required, you're only going voluntary for the audit. What happens is that, say, in your case, you missed the 31st July deadline of filing return of income. Now you said, no, I will have to face the consequences, penal consequences. What you did? You go for the voluntary audit. Of course, you can get the audit voluntary, and there's no bar. And you said, now my due date is 31st October, and if filed by 31st October, there should not be any penal consequences. No, sir. There will be penal consequences if the audit was not required under the law. 31st October due date is only if the audit was required under the law. See, we are a CA finance students, and it's our duty, and it's in our favor also in our benefit to go deep into the provision to understand the intricacy, the minute points, which will help in exam and practical in both ways. Okay, so a person who is required to get the account audited is 31st October. For a company, whether audit or not, 31st October. By the way, in case of company, there is always an audit. The companies are act required statutory audit in case of all companies. Okay. Now, section 5A. What does section 5A say? Here is section 5. So there is a system of community, Portuguese Act, as Geeta rightly said, in 3 parts of the country: Goa, Dadra, Nagar Haveli, and Daman and Diu. What is that? Section 5A say. What is that? Community of system. In community system, the income of husband and wife is not separate. This aggregated. This actually couple in financial terms as well. So section 5A say if you are governed by that system of community, then you are husband and wife and you are governed by that system of community, then income under salary shall be taxable in your individual respective hand, whoever earns it. So if I am governed by that system, so if I am earning the income from salary, it will taxable in my hand. My wife is earning, it will taxable in her hand. But in respect of all other income shall be aggregated and equally divided. All other income is income under house property, PGBP, capital gain, other source. The income other than the salary shall be aggregated and equally divided between husband and wife, and each of them shall pay the tax on their proportionate part. Okay. So if there is other income of 10 lakh, then 5 lakh shall go to in the hands of husband and 5 lakh in the hands of wife. And they will include their income in their respective return of income. So now you understood this? This is on the left hand side of my notes. So by left hand side, I mean either the pictorial description of what is written on the right hand side, or not so important from exam point of view. Okay. So we understood that for a firm whose accounts are required to be audited, the due date is 31st October. For a partner of such firm, the due date is 31st October because his income is dependent upon the income of the firm. And spouse of such partner, if section 5A applies, is again dependent upon the income of the partner, because the salary what he is driving for the partnership firm is taxable under PGBP. It will be a portion between the husband and wife. It's not this salary from partnership firm is not taxed under that salary, it's taxable under PGBP. It has to be a portion between husband and wife equally. If husband is a partner and he's getting rupees whatever salary, so whatever is taxable in his hands will be equally divided between husband and wife. So the income of wife is dependent upon the partner. Income of partner dependent upon the firm. So they increase the due date for all this. For the firm, 31st October, partner of such firm, 31st October, spouse of such partner, if section 5 applies, 31st October. Okay. Then here comes the TP. the second due date, 30th November, it is for the person who is required to furnish a TP certificate in section 92E. You understand TP, transfer pricing? If there's a transaction between associated enterprises, there's a associated enterprise outside India and you are dealing with them, then you're required to furnish a TP certificate. So if there's a requirement on you to furnish a TP certificate, then due date for you is 30th November. Again, if that entity who is required to furnish TP certificate is a firm or LLP, then for a partner of such firm or LLP, again 30th November, and spouse of such partner, if Section 5A applies, again 30th November. Section 5A applies in the state of Goa and in the UT of Dadar Nagar Haveli and Daman and Diu. Need not to remember. Apart from all this, the due date is 31st July. So all salary class people come under 31st July. Yeah. The major chunk of Indian population comes under 31st July. Therefore, we always keep remember 31st July. Understood? Let's revise the due dates with the help of a chart. This chart will help you during exam time. So due date 31st October for a company, no condition. For a company, it's always 31st October. Any person whose accounts are required to be audited, all partners, understood? Whether working, non-working, you don't need to apply your mind. All partners of a firm whose accounts are required to be audited. Spouse of such partner, Section 5 applies. 30th November is the due date. For whom? Any person required to furnish report in Section 92E. All partners of a firm who is required to furnish report in Section 92E. Who is required to furnish report in Section 92E? It's a firm. So for firm is 92E here, and for his partner is here. And the spouse of such partner, Section 5A apply, comes here. In any other case, 31st July. Understood? If I don't file by this time, then there are penal consequences which we will discuss in a minute. So my 139(1) says two things. Who is required to furnish return of income, which we have covered extensively. Any doubt? Do ask. Secondly, what is the due date of furnishing return of income? Okay. Any doubt? Please let me know. If you want to that I reduce my speed or something, do let me know. Okay? Now there are different types of return of income. Okay. All are covered under Section 139 itself. So before we go into that, let's discuss what is the penal consequence if I don't furnish my return of income within a time allowed under Section 139(1), which is 31st October, November, July, as the case may be. So here is the penal consequence for not filing return of income on time or not filing return of income at all. So one is there is a fee of under Section 234F. So if I don't file the return of income by time, then there is the government levies a fee. And the amount of fee is rupees 5,000. But if my income is less than rupees 5 lakh, the amount of fee is rupees 1,000. So let's read it. Where a person who is required to furnish a return of income fails to do so within the due date. What is the due date? We all know. 31st October, November or July. Where a person who is required to furnish a return of income fails to do so within the due date, he shall pay by way of fee a sum of rupees 5,000. So if I file my return of income after the due date, I have to pay a fee of rupees 5,000. However, if I file the return of income of a return with an income of less than rupees 5 lakh, then the fee is only rupees 1,000. Understood? Two things on this. Firstly, now what is this fee? We understand there is a tax. We understand there is interest. We understand there is a penalty. You understand all these things? You understand there is a payment of tax, which is controlled your income. There is a payment of interest. If you pay the tax delayed, then there is an interest liability. Then there is a penal consequence, penalty liable for many defaults under the Act. Okay. Now, another thing comes, which is a fee. Is it equal to penalty? Can anybody tell me? What is a fee? And why there is a concept of fee? Why can't they say it's a penalty? actually, if I tell you quite some time before, it was only a penalty for not filing return of income on time. Subsequently, they deleted that penalty and reduced a fee, Section 234F. So, what is the difference between penalty and fee? Both are levied because there is a default done by the assessee. But why we are calling it a fee, not a penalty? Because it is in the favor of government. Here, I tell you, penalty is never automatic. For a penalty, you have to give an opportunity to the assessee to explain why this default occurred, why you did not file return of income on time, what was the reason which prevented you from filing return of income on time, and if the reasons are reasonable, sufficient, explainable, justified, then penalty shall not be levied. So, to levy a penalty, there has to be a proceeding. The tax officer will give you a notice, ask you why he should not levy a penalty. You will give your response. You will say, I could not meet the compliance because of this reason, and these reasons were beyond my control, and therefore, pardon me, or don't levy a penalty. And if tax officer is satisfied with your reason, he will not levy a penalty. So penalty is never an automatic thing. Therefore, they introduce the concept of fee. Fee is automatic. You have to pay the fee whether the delay is reasonable, justified, you had a reason beyond your control or not. The fee is payable irrespective of the reason. You don't need to go into the whatever the reason for delay. So it's in the favor of the government. Okay. So this small things creates a difference in the understanding. It doesn't create them. So if you don't file a return of income, if the assessor doesn't file a return of income on time, there is a fee which has to be paid by him. The fee is rupees 5,000 lump sum amount, and the total income is less than 5 lakh. Then the fees is rupees 1,000. Is a total. This 5 lakh is the total income. Okay. Now, answer me one thing. Assume I file a return of income after the due date, and I file a return of income of say rupees 2 lakh. Then what is the amount of fee which I will be required to pay? Is it 1,000 because my total income is less than 5 lakh? No. The answer is I will not be required to pay any fee. Why? Because 234F doesn't apply on me. What 234F say? Where a person who is required to furnish return of income, my income is less than the basic assumption limit. So getting my point, assuming my GTI and everything is less than the basic assumption limit, I was not required to furnish return of income, then there would be no fee. Not even 1,000. The 1,000 will come only if I am required to furnish return of income. So similarly, what we saw in case of audit. So if I am required to furnish return of income and I don't furnish, then there is a fee. If the income is 5 lakh or less, then fee of 1,000, more than 5 lakh, then 5,000. Understood? See, there is no bar. 131 says only list down the person who are required to furnish return of income. They have to furnish return of income in any case. But it no way stop from voluntary furnish return of income. Assuming you are not coming under any of the clauses of 131, still you can file return of income. See, you are a student, you don't have any income, you have not deposited the amount in current account, saving account, that you won't come under, have not incurred any expenditure. So you don't come under any of the clause 131, but still you can file return of income. There is no bar. Okay. So understood 234F. If I don't file return of income time, then there is a fee of 5,000 if income exceeds 5 lakh. Income is total income. And rupees 1,000 if income is 5 lakh or below. Another consequence of not filing return of income is interest under section 234A. So what 234A says, in income tax act, the interest is which the assessee has to pay for always 1% per month or part of the month. So 234A says that if you don't file the return of income on time, then there is an interest of 1% on the tax due. It will be levied from the day immediately after due date up to the date you furnish return of income. Okay, we'll discuss this in a minute in detail. Okay, so these two are the major consequences. We'll come back to this again. I require this for my understanding of different types of return. So I have done 101. Now I'm coming to 139.3. What 139.3 says? 139.3 says that if you don't furnish your return of income in time, the time means within a due date as explained in 139.1, then you will not be allowed to carry forward the losses. Which losses? Loss under PGBP, loss under capital gain, loss from the activity of owning and maintaining resource. These three types of losses you will not be allowed to be carry forward. Okay. So if there is a loss under either of these heads, then it makes all the more sense to file the return of income within the due date. Okay. One thing, the restriction of carry forward is only respect to these three losses. There are two other losses. One is loss under house property and unabsorbed depreciation. There is no restriction. Even if return is filed late, you can carry forward, we can carry forward these losses, which is house property and unabsorbed depreciation. Hope you are with me. So Act restricts the carry forward loss. Which loss? PGBP, capital gain, and loss from owning and maintaining resource. In the PGBP, all losses, whether it's a loss from speculative business, normal business, or specified business under section 3580, all types of loss shall not be allowed to be carried forward. One more thing, the restriction is on the carry forward. So, assuming for the assessment year 26-27, I have a loss in PGBP, say rupees 5 lakh. And in the same year, I have an income in house property, say rupees 4 lakh. So this is loss, PGBP ka loss, and there is an income in house property of rupees 4 lakh. And I filed my return of income after the due date. So what the law says that the loss under PGB shall not be carried forward, but it can of course be set off. So I'll set off this PGB loss against the house property income, and the net result would be 1 lakh loss. This loss cannot be carried forward because I filed return after the due date. So my 139.3 applies after the loss remaining after set off. Understood? It applies only on carry forward. It doesn't restrict the set off. One more thing. Assuming I filed, there's a loss in AY 25-26 of rupees 1 lakh. Under the head PGBP. I filed the return of income for 25-26 on time. So I am eligible to carry forward it. For AY 26-27, again there is a loss under that PGBP of rupees 2 lakh. And I delayed in filing the return of income. So this 2 lakh shall not be allowed to be carried forward. Okay. Now I come to AY 27-28. There is an income of rupees 5 lakh. The question comes, I understood the point that this 2 lakh shall not be allowed to be carried forward. The question comes, can I set off my 1 lakh loss of AY 25-26? What's the controversy is that in AY 26-27, I didn't file my return of income. Perfect, Geeta. Yes. Because we have to see the return of the year in which loss is occurred, not to subsequent year. If for the 25-26, I file the return of income on time, then this 1 lakh rupees shall be allowed to be carried forward, set off in future years. Even in the intermediary year 26-27, I didn't file my return of income on time. So this will affect only for the loss of 26-27. It will not affect the loss of the earlier years. Okay. So again, for the year 27-28, I shall be allowed to set off rupees 1 lakh and my income shall be full. Okay. Understood? So this was 139.3. Now we come to 139.4. Belated return. You need not to remember each section. Just remember the language. language what the provision says. You need not to remember the exact language, the verbatim which the act uses, but you must remember what the provision says exactly. If the provision says that they require to be furnished return of income, then you have to say required to be. You have to be specific amount or more than. Then I don't need the ICAI is not concerned about the language, but it's concerned about the understanding of the student. The provision should be perfectly understood. Belated return. If I don't file my return of income within time, then Act allows me to file the return of income even belatedly. Mistakes are pardoned. So what is the time by which I can file the belated return? The return which I could not file within the time is, if return is not filed within the due date, it may be filed before 3 months prior to the end of relevant assessment year or before completion of assessment, whichever is earlier. So I can file the return from my exam assessment year is 26-27. So the due date was say 31st July 26. If I could not file by 31st July 26, then I can file 3 months prior to the end of assessment year. So my assessment year ends on 31st March 27. 3 months prior means 31st December 26. So I can file my belated return latest by 31st December 26 if my assessment is not completed by then. However, if my assessment is completed even before that, then I cannot file my belated return after the completion of assessment. There is no use. Assessment has already been done. He has assessed your income. He has computed the tax liability, whatever is due on you. So what will you do by filing return of income? So the limit is either 3 months before the end of the assessment year or completion of assessment, whichever is earlier. It's not necessary, I told you, to use the same language. You can say 9 months from the end of the previous year. So either of them will fetch you marks, but you cannot be wrong. The meaning should be same. So the time limit is you file the return of income 3 months prior to the assessment year or before completion of assessment, whichever is earlier. Okay. Of course, if you're filing belated return after due date, then the penal consequences shall apply. There has to be a difference between a person who is filing return by due date and a person who is filing after due date. So if you're missing the due date, then what penal consequences shall apply? You may have to pay the fees. There will be interest under section 34A, and if there are losses under PGBP, capital gain, or owning and maintaining resources, then those losses shall not be carried forward. Understood? Another section is the revised return. Revised return means you can revise your return. You can amend your return. If you find some wrong statement, some mistake in the return filed by you, then you can revise the return. Which return I can revise? The return which I filed within time or the return I filed belatedly. So both. You can file whether the return was filed within time or belatedly, you can revise both the return. Whether return is 139.1 return or 139.4 return. So return furnished on 139.1 normal return or a belated return 139.4 may be revised to correct any omission or wrong statement therein at any time before 3 months prior to the end of relevant assessment year or before completion of assessment, whichever is earlier. So time limit is same for 139.4 and 139.5. For belated return and revised return, the time limit is same. Return can be revised up to 9 months from the end of the previous year or before completion of assessment, whichever is earlier. The same time limit was there. Time limit was there for belated return. Hope I'm clear. Any doubt? Let me ask. Let me know. I happy to answer. Okay. So what the question comes, how many times can I revise the return? So there is no limit. You can revise return some number of times, provided the revised return is within the time limit. What is the time limit? 3 months before the end of relevant assessment year or before completion of assessment, whichever is earlier. You can revise n number of times. No worries. What happens to my earlier return when I file a revised return. So the law says is that your revised return steps into a shoes of the earlier return. The revised return provision is used by the professionals in very, very beneficial way. I tell you. What happens is that the due date of filing return of income is say 31st October. And in one of your client case, and you are overloaded with the work and you don't have a time. But you know there is a law in his case. If you don't file the return by the due date, the assessee will not be able to carry forward the loss and it will be a huge loss. See, fees of the 5,000 or 1,000 is not much material, but if there's a loss of say rupees 10 lakh rupees, which you could not be carried forward because the CA did not file the return of income on time, then it's a big implication. So practically, I'm just discussing the practical aspect. Practically, what CA does, they file the return by the due date by putting anything, and by the 31st December, they revise it. So what happened when they revise it? The revised return steps into the shoes of the original return. So it is deemed that the revised return is filed within the due date. Okay. So once the revised return is filed within the due date with the loss, assessee will be able to carry forward the loss. So you understood the concept? Assessee filed the return of income under 139(1) and show the income. Under section 139(5), he revises the return and shows the loss. The question comes whether this loss can be carried forward. Answer is yes, because this return steps into the shoes of 139(1). It will be deemed it is filed on the date in which 139(1) was filed, and therefore 139(1) was filed within time. Therefore, this loss can be carried forward. Am I clear? Do ask me anything. Now we come to a defective return. For this, we'll take a small 1 minute break. Okay? Thank you. But before that, let's do some questions to revise the concept till now what we have studied. So there are some MCQ we will do in a minute time. In which of the following cases an individual who is of the age of 45 years is required to furnish a return of income? So you have to answer whether this person is required to furnish return of income or not. If his total income is 2,50,000 and he's claiming a refund of 15,000 from TDS deducted from interest on fixed deposit. So total income does not exceed the basic assumption limit, assuming there is no deduction and 54 assumption because question is silent. And the fact that he's claiming a refund doesn't create a liability on him that he's required to furnish a return of income. Okay? So he's not required. When total income before allowing deduction at chapter 6A exceeds 2,50,000. So there's a direct answer. This is a direct requirement section 139.1. If your total income before 6A exceeds 2,50,000, then perfect. Geeta has answered. That's B. In all cases, respect of any income of loss, no. Non-resident having nil income in India and bungalow in Switzerland. So bungalow in Switzerland, he is asking that you have asset outside India. But that clause applies only in case of ROR. He's a NR. So he's not required. And then anyway would have an asset outside India. You cannot ask each NR of the world to file return of income in India. Yeah, you don't have an access. You have an access only with the ROR. Second, which of the following person is not required to furnish return of income? Now I have to answer who is not required. Mr. I hope it's visible. Mr. Y, aged 81 years, having GTI of ₹5,50,000, total income of ₹4 lakh, after deduction of ₹1,50,000 under chapter 6. So here the GTI of ₹5,50,000, exceeding the exemption limit, is required to furnish return of income. Varun, resident and not ordinary resident, having a total income 1,40,000 in India, the income is less than basic assumption limit, but he has a bungalow in Germany and bank account in London. B. For question number 2, if Yogesh is answering for question number 2, then he is not required to furnish return of income. Perfect. And university is having a total income of nil after an assumption of ₹3 crore. We have not studied this. A company which is yet to commence commercial production, there is no income during the year. So this company is also required to furnish return of income because companies in any case required to furnish return of income in all cases. So only B is not required to furnish return of income because it's R and OR. Had it been an ROR, he would have been required to furnish return of income. Okay, so rest of the MCQs we will discuss in a minute. I need to discuss one or two more concepts which will be asked in this MCQ. Okay. So another type of return is the defective return. What is defective return? It's nothing if the return which the assessee has filed, but the tax officer has found some defect in such return. Defect means there is some error, there is some mistake in such return. So what is the course of action which the AO will do? AO means assessing officer. We call them AO. The AO will write a letter to the assessee and ask him to rectify the defect. He will give him the 15 days time from the receipt of the intimation. Intimation means the letter. Once the letter is received by the assessee, he will have a 15 days time to rectify the defect. By rectifying the defect, you can file a new return as well in response to the defective notice. Okay. If this 15 days period is not sufficient, assessee may ask for the extension and AO may or may not exceed. It depends upon him. But if the defect is not rectified within this 15 period or extended period, as the case may be, if it was allowed to you, then it is deemed that you have not filed the return of income. The assessee has not filed the return of income. Understood? If there is a defect, AO notices a defect and he writes an intimation to the assessee to rectify the defect. And even after such intimation, assessee doesn't rectify the defect within the given time, prescribed time, then it will be deemed that he has not furnished a return of income and all penal consequences shall apply. Okay. But even after the period of 15 days or extended period, as the case may be, assessee may rectify the defect, and AO may also condone the delay if he wants, provided the defect is rectified before completion of assessment. So let's study. Where AO considered that the return furnished by assessee is defective, he shall, it's mandatory for him to intimate, he shall intimate the defect to the assessee, who shall rectify the defect within 15 days from the date of receipt of the intimation. So whenever the intimation is received by the assessee, he will rectify the defect within 15 days. The above period of 15 days may, on the request of assessee, be extended by AO. Assessee may ask for the extension, AO may extend it if he is satisfied. If defect is not rectified within the period of 15 days or extended period, the return shall be deemed to have never furnished. It will be deemed that assessee has not furnished the return of income, and all penal consequences shall accordingly apply. However, AO may condone the delay if defect is rectified after the aforesaid period but before the completion of assessment. So even if the assessee rectifies the defect after the expiry of the prescribed period, the 15 days or the extended period, the case may be, still AO can condone your delay, the delay of the assessee, if the defect was rectified before the completion of assessment. But whether to condone the delay or not, it depends upon the AO. And it's his discretion. It's not mandatory for the AO to condone the delay. He will see the reason for the delay, and if he found such reason as reasonable, he will condone, otherwise he will not condone. Now, what is a defect? When we say that it is defective, what defect would AO must have noticed so that he feels that the return is defective? See, this provision was very much relevant earlier when there was manual returns. Now what happened is that there is a digital return, and the return is annexure-less return. When I file my return of income, I am not allowed, I am not asked, I am not supposed to furnish or attach any annexure, any supporting in support of my return of income. It's an annexure-less return. I cannot. It's a digital return. The system doesn't allow me. Okay. So because of this, the relevance of this section is not much in current scenario, but from exam point of view, we need to do everything. Okay. So a return of income shall be regarded defective unless the following condition is fulfilled. So if any of the following conditions is not fulfilled, it will be deemed as a defective. The annexure statement columns related to computation of income under each head of income, computation of JTI and AI have been duly filled in. So if there is any missing column or information in respect of computation of income, then AO may consider it as defective. Again, I'm saying this, the form doesn't allow me to remain, to keep the mandatory field vacant. The return doesn't get filed, and the return form doesn't get validated. So it's more of a theoretical section. The return is accompanied by the following. So the section says if my return is not accompanied by the following, say the tax audit report, then my return is defective. But now a case is that I cannot attach tax audit report because it's an annexure-less return. So what happens is that the return form has columns where it asks the information about the tax audit. So who is the tax auditor, when the tax audit report was signed, when the report is furnished. So he asks all this information, and if these information are furnished, then it is deemed that tax audit report is furnished with the return of income. Understood now? So there is physically no tax audit report attached with the return of income. It's on the particulars of the tax audit report which is provided in the income tax return form. So return of income is to be accompanied by a statement showing computation of tax payable on the basis of return of income. Of course, this is the main part of the return of income, the computation of tax liability. Tax audit report, cost audit report if undertaken by a cost auditor, the proof of TDS and TCS and advance time self-assessment tax. So whatever tax already paid for which I am claiming the credit, it says that return has to be accompanied by the proof of such TDS or TCS. But this is an annexure-less return. So what I do is I furnish the detail of TDS and TCS. I furnish the TAN number of the person who deducted a tax. I furnish the amount of TDS deducted in respect of advance tax, self-assessment tax. I furnish the challan number, the BSR code, date of deposit of the tax, and these details I furnished in lieu of this. You understood now? The proof of payment of tax under section 140B if return of income is an updated return. Put a dollar mark here. We have not studied updated return. We'll do it in today's class itself. So we'll discuss. We'll come back to this. By dollar mark means we'll come back to this. If regular books of accounts are maintained by SSC, the return is accompanied by the copies of manufacturing account, trading account, P&L account, income expenditure account, or balance sheet. Again, these all things are being filled up in the return form. It's not attached. Personal account of partner, member, as the case may be. If you are a partnership firm, then you have to put the personal account, detail of personal account of partners. If you are a partner, then you have to put your personal account in the partnership firm. The opening capital, the closing capital, the profit, drawings, and all. If regular books of account are not maintained, the return should be accompanied by a statement indicating the amount. Okay. So, if you are not maintaining books of account means you are going under the presumptive. Presumptive means section 4480. If you have a business and you are not maintaining books of account means you are going under the presumptive taxation 4480 or 4480 as the case may be. If you have business, then 4480. If you have profession, then 4480. In such cases, you have to give the figures of your turnover, your gross profit, expenses, net profit. So 4 figures for the P&L account. What? Gross turnover, then your gross profit, then your expenses, then your net profit. And in case of balance sheet, you have to give the amount of debtors as on last day of the previous year, creditor, stock, and cash balance. So four things for the P&L and 4 things for the balance sheet. If your books of accounts are not maintained, at least these 8 figures you have to put in the return of income. Otherwise, your return of income shall be considered as defective and you will receive a notice from the AO. Okay. So once you receive a notice from the AO has to give you a 15-day time. There is no discretion whether he can give more than 15 days or less than 15 days. The act itself says you have to give the 15 days. Now, this 15 days can be extended depending upon the discretion of the AO. Hope I'm clear. Okay. If defect is not rectified, then it will be deemed that SSC has not furnished a return of funds. A very small topic, modified return, not of very much important. What happens is that in case of business reorganization, amalgamation. What is amalgamation? A Limited amalgamates with B Limited. Okay. So A Limited gets merged into the B Limited. What happens is that the amalgamation is through the court procedure or procedure of NCLT. So there is an order comes from the High Court or the NCLT for the amalgamation. What happens is that order comes very late and the amalgamation is effective from retrospective date. So if amalgamation is effective from 1st April 25, the order of High Court or NCLT may come, say, 25th November 26. Okay. So on 25th November 26, the NCLT will say that A Limited is merged with B Limited with effect from 1st April 25. Understood? The whole of the transaction of A Limited on or after 1st April 25 shall be deemed to be a transaction undertaken by B Limited by this order. But order came on 25th November 26. But by this date, the B Limited has already filed his return of income for the financial year 25-26. And this return of income would be the standard return of income of the financials of the transaction of the B Limited. But by this order, the B Limited should have merged the accounts of A Limited as well for their 25-26. Because with effect on 1st April 25, A Limited has merged with B Limited. Understood? So, the law says, section 178, B Limited, the new company, the successor company, can file a modified return. It can modify its return which he has already filed. Okay. Can file a modified return, and the time limit of filing modified return is 6 months from the end of the month in which this order came. So in our case, the order came 25th November 26. So B Limited can file the modified return by and this month 30th November and 6 months from 30th November. December, January, February, March, April, May. By 31st May 27, B Limited can file a modified return. Understand? In a very small section. In case of business reorganization, where prior to the date of order of High Court, Tribunal, or adjudicating authority, as the case may be, any return of income has been furnished for any assessment year to which such order applies. So B Limited had already furnished the return of income for 25-26 to which this order applies before the date of the order. The successor entity, B Limited, has to furnish a modified return in the period of 6 months from the end of the month in which said order was issued. Okay, so my order was issued on 25th November. I ended that month, come to 30th November, and I count 6 months from there. Okay. Assessment for such year shall be done on the basis of modified return. Of course, subsequent assessment shall be done on the basis of modified return. So Act says there may be a scenario that even before the order, the assessment may have been completed. The B Limited have filed the return, and the return has also been assessed by the tax officer. But in such case, the assessment has to be modified on the basis of the order and the modified return. And if assessment is under process, is ongoing, then the tax officer shall consider the modified return while completing the assessment. So it says if assessment has been completed, the AO shall modify the total income. So whatever total income he has computed, he will modify it in accordance with the order of the business reorganization and the modified return. Of course, very logical. If assessment proceedings are pending on the date of finishing modified return, the proceedings shall be completed considering the order of business reorganization and the modified return so furnished. Understood? Okay. So till now, we have studied different types of returns. So all these returns are this. So we have studied all this. 7 types of returns. This I have summarized for your benefit. So 139.1 says normal return, mandatory return. What is the time limit? 31st July, 31st October, 30th November of the assessment year. You are with me. Wherever you have doubt, do ask. 139.3 says loss return. The loss return has to be filed within this time. Otherwise, the loss under PGBP, capital gain, and owning and maintaining resources cannot be carried forward. Sorry. 139.4 says if you could not file the return within due date, you can file the belated return. Time limit 31st December assessment year or completion of assessment, whichever is earlier. 139.5 revise return. Again, the same time limit. You can revise n number of times within this time limit. 139.8a updated return. We have not studied it as yet. 139.9 is a defective return. You have to rectify the defect within 15 days of receipt of intimation or the period extended by the AO as the case may be. And lastly, 170A modified return, which you have to file by 6 months from the end of the month in which order is issued. Who have to file? The successor company. In our case, B Limited. Clear? Okay. Now we'll do the penal consequences in detail. Because I need this before the start of my next topic, updated return. Okay. Or. Listen to me very carefully. So if I don't file, if SSC doesn't file a return of income within a due date, then there are penal consequences. One of the consequences we have studied in detail, fees. Fee 234F. So there's a fee of rupees 5,000. But if the total income is up to 5 lakh, then a fee of rupees 1,000. And fee is levied only if I was required to file the return of income. Then interest is levied under section 234A. So you will study this in detail at the time when you will study the interest parts, different type of interest, 234A, B, C. we are discussing here because it's relevant for this chapter as well. So 34 is levied. What is the default? Default is assessee doesn't furnish the return of income on time, or he doesn't furnish at all. So default return of income is furnished after due date or is not furnished at all. Even in such case, interest on 234 is levied. What is the rate of interest? It's simple interest rate of 1% per annum per month or part of the month. So in entire act, the interest is levied at the rate of 1% per month or part of the month. Part of the month, I mean, even for 2 days, the entire interest of 1% shall be levied for the entire month. Okay. To compute the interest, I need 3 things: the amount, the rate, and the time. Okay. So I got the rate, which is simple interest, 1% per month or part of the month. Now the time, for how much period the interest shall be levied. Very logical. Everything is very logical. If I ask you, you will answer the interest shall be levied when the default starts. When the default starts? After due date. So immediately after due date, the interest clock shall start running, interest shall levy, and the clock shall stop when I actually furnish the return of income. So interest is levied period commencing from the date immediately following the due date, and where return is furnished after the due date, ending on the date of furnished return of income. So if my due date was 31st July, so interest shall be levied from 1st August. If I file say on 30th November, it's 30th November. August, September, October, November. 4-month interest means 4% interest shall be levied, 1% per month. Had it filed on 25th November, then also 4%, because a part of the month is considered as a full month. Okay. Come back. But if I have not furnished return of income at all, then what would be, till how much time will government levy the interest on me? In such case, interest is levied up to the date of completion of assessment. So if I have not furnished return of income and an assessment has happened on me, so up to the date of completion of assessment, the interest in section 234A shall be levied. So I got the time, I know the amount, I know the time, and I know the rate, I know the time, now the amount. Again, a very logical thing. On what amount the interest should be levied as per it? Of course, the amount which was due in the return of income, which I did not pay to the government. You know? So, tax computed under section 143(1) or under regular assessment. We'll discuss this in the next class, 143(1) or regular assessment. For the time being, you take it as a tax and as per the return of income. So, tax, whichever I compute, tax liability I computed in the return of income, I reduce by the advance tax, which I've already paid, TDS and TCS, again already paid, any relief allowed under section 89, 90, 90A and 91. I hope you know this. I'll remind you. Section 89 is the relief for advance or arrear of salary. Section 90, 90A and 91 are the foreign tax credit. If I have an income which I earned outside India and the foreign country also deducted tax, then I am allowed to take a credit of the foreign tax, the tax deducted by the foreign country, against my Indian tax liability. So this section allow me that. So my liability will be reduced by such credit, MAT or AMT credit as the case may be, for any self-assessment tax paid up to the due date of return of income. So if I reduce all this for my tax liability, what I will get? I'll take the tax payable at the time of filing return of income. This would be the amount which I ought to have been paid if I had filed the return of income on time. So on this amount, I have to pay the interest at the rate of 1% per month or part of the month. For the period up to the due date, up to the date I furnish the return of income, or if I have not furnished return of income at all, up to the date of the assessment. You will do this again when you will do the interest chapter. Okay. So another consequence is I have to pay the interest if I don't file the return of income within time. Then there is a penalty as well for 272A. Put a dollar mark. I have not covered this as yet. Then lastly, the disallowance of carry forward losses, which we have already studied. Okay. So these are the sectoral presentation of the penal consequences if I don't furnish return of income within time. I have to pay fees, clear? Any doubt? I have to pay interest, clear? The carry forward of losses is not allowed. Which losses? PGBP, capital gain, and loss from owning and maintaining resources. Now, section 10AA and some section of chapter 6A, income linked deductions. And section 80 IAJJ. This section imposes a condition that the deduction shall be allowed only if the return of income is furnished by the due date. So if return of income is not furnished by the due date, the SFC shall not be allowed to claim a deduction under section 10AA, SCZ, and some specific deduction chapter 6A. Further, if you remember, the option to shift out of the default tax regime can be availed only before the due date of furnishing return of income. So if I have not furnished return of income by the due date, I will not be allowed to shift out of the default tax regime. I have to mandatorily file my return of income under the default tax regime. I'm clear? What is the difference between modified return and a revised return? Neha. See, modified return is filed only in case of business reorganization. But there is no such condition in case of revised return. You can file a revised return just to rectify any omission or wrong statement in your return. You find some omission, wrong statement in the return of income. You can revise the return by the time specified therein, which is 3 months before the assessment year or before completion of assessment, whichever is earlier. But modified return is filed only very specific circumstances in case of business reorganization. Business reorganization means amalgamation, demerger, succession. So if there is such business reorganization, only in such case modified return is filed. At this point, one more thing. See, I told you that in exam you don't need to write the exact verbatim of the language, but there are some specific word which have a specific meaning assigned to it, and this word define such meaning. So if I use the word modified return, then everybody interpret it in a sense that it's a return filed in consequence of business reorganization. You cannot say use the word modified return in place of revised return. Understood? For very few places in the act, there are some specific word which have a specific meaning. So if you're using that specific word, you can use that specific word only for that meaning. Okay. So this modified return, revised return have a specific meaning. I hope, Neha, this is clear. The modified return is filed only in case of business reorganization. But revised return can be filed by any assessee. Anybody who has filed return of income under 139(1) or belated return 139(4), if he finds any wrong statement therein, any defect therein, he can revise it. And of course, the time limit for filing revised return is very limited, 9 months from the end of the previous year. But the time limit for filing modified return is dependent upon the order of the authority, the High Court or the tribunal or any adjudicating authority, whoever it may be. So, and the time limit for modified return starts from there. So, whenever I see when the order is issued, I end that month, and from there, 6 months from the end of that month. Okay. Okay. So, I was waiting for this. There are a lot of questions asked, so we were just skipping this. Following persons are required to furnish return of income. So, 131 gives a list of persons who are required to furnish return of income. But here, there are some section 4A, 4B, 4C, who again says that these persons are required to furnish return of income. So, you don't need to remember the section, just remember who are these persons and when they are required to furnish return of income. Very logical. I'll explain you. So it says that charitable religious trust referred to in section 11 and 12. They are required to furnish return of income when if total income without giving effect to the provision of section 11 and 12 exceeds the basic assumption limit. So what happens is that, friends, this charitable organization or religious organization are registered under section 12A. And by virtue of this registration, their taxable income generally comes nil. They are allowed the exemption under section 11 and 12. So their income is below the basic assumption limit and they are not allowed, they are not required to furnish return of income in section 139(1). But government actually want to see whether you are actually doing the charitable purpose for which the registration was allowed to you, for which the exemption is given to you. These NGOs and all, trust NGOs and all schools, hospitals generally are constituted as a trust or society to claim the exemption. So the total income after the exemption is in any way less than the basic exemption limit, generally from nil. So they are not required to furnish return of income. If they will not furnish a return of income, how the government will be able to, how the tax officer will be able to even check whether they are fulfilling the condition of registration or not? Understood? We will do it this in more detail in the next class. But for today, at least I want to understand whether you are fulfilling the condition or not, and that I will be able to see only if you file the return of income. So the law says if your income without giving effect to section 11(12) exceed basic exemption limit, means if your income without giving the exemption exceeds the limit of 2.5 lakh, then you are required to furnish return of income. And if you don't furnish, then there's a penalty. We'll study in a minute. This 139(4)A says. Similarly, 139(4)B puts a liability on the political party to furnish return of income. Again, in case of political party, there is section 13A, which says the entire income of political party is exempted. So total income is nil, below the basic exemption limit, and 139(1), there is no requirement. So the Act says, if total income without giving effect to the provision of section 13A exceeds the basic exemption limit, then the political party is required to furnish return of income. Understood? Why this liability is on this organization? Because the exemption is provided to this organization for subject to some condition. The tax officer at least want to see whether you are fulfilling that conditions or not to be eligible for the exemption. So for that, they are asking if your total income without the exemption exceeds the basic exemption limit, then file the return. Understood? Any association, institution, fund, trust, news agency, trade union, infrastructure, debt fund, mutual fund, securitization trust, venture capital company or venture capital fund, or any other person referred to in section 10. So there's a section 10. You don't need to remember the name of all the organization. So there's a section 10 which exempts the entire income of all these associations. Trade unions, venture capital fund, mutual fund 1023D and all this. So news agencies, etc. It exempts the complete income of earned by these organizations. Okay. Again, the similar issue. So if they don't file the return of income because they are not coming under section 139(1) because the total income is less than the exemption limit, then the tax officer will not be able to check the conditions that they are fulfilling on the basis of which the exemption is allowed. So the law says they are required to furnish return of income if the total income without giving effect to the provision of section 10 exceeds the basic exemption. Okay. Now, if you see section 11 and 12, which give exemption to a charitable religious trust, the section 11 and 12 says that if the income of the trust without the exemption exceeds the limit, then the trust is required to get the account audited. Understood? So if the trust is required to get the account audited, then due date for the trust shall become 31st October. Understood? How 31st October came? Because my 139(4)A says the trust is required to furnish return of income if its income before the exemption under section 11 and 12 exceed the basic exemption limit. Section 11 says I will give you exemption only if you will get your accounts audited if your income is before the exemption exceeds the basic exemption limit. Okay. So the requirement to file the return is if your income without exemption exceeds the exemption limit, then in such case you're required to get your account audited by virtue of section 11, and therefore, since your accounts are required to be audited, the due date for funding return of income becomes 31st October. Same thing happens in case of political party. The exemption to section 13A is available only if you get your account audited, if your income exceeds the basic exemption limit before exemption. So similarly, if your accounts are required to be audited, then due date becomes 31st October. In case of these organizations, if there is a liability to get the accounts audited, then the due date shall be 31st October. Otherwise, the due date shall be 31st July, as the case may be. But for charitable organization and political party, the due date shall always be 31st October because the exemption is allowed only on the condition that your accounts are audited. Understood? Okay. So these are section 104A, 4B, and 4C, which says that these organization has to file the return of income. But at the same time, this section says the return of income furnished under section 104A, 4B, and 4C shall be deemed to be the return furnished under section 139(1). Now, why it is written so? So Gita is asking, what is the basic exemption limit for all these? Is all these come under AJP? So Gita, for all these, they are the basic exemption limit of the individual, which is 2.5 lakh, is applicable for the trust, society, and all. Okay. So now these sections say 104A, 4B, 4C say the return furnished under this section shall be deemed to be the return furnished under section 139(1). Why? This is because if you remember under section 139(5), revised return, it used to say the only return furnished under section 139(1) and 4 can be revised. See. Return furnished under section 139(1) and 139(4) can be revised. So had 104(8) not contained this provision, then the charitable organization would not have been able to revise its return. But now, since it says that the return furnished under section 194A shall be deemed to be the return furnished under section 191, now the charitable organization or political party or other organization which are exempt under section 10 can furnish the revised return as. Okay. If you remember, on the first page, we left a small thing. These three entities. So this is 4D, 4E, 4F. No need to remember section. 104D, 4E, 4F says that these entities shall be required to furnish return of income in all cases, irrespective of the income, the amount of income or anything. Like company or firm, a university, college, or other association referred to in section 35. Remember, there is scientific research section 35 under PGBP, where if a assessee gives a donation to this organization, then deduction is allowed. Okay, so these organizations are mandatory required to furnish return of income because, again, they are registered, they are given the registration approval to receive the donation from the business assessee, and on that basis, the deduction is allowed to the business assessee. So the government want to see whether these organizations are doing for what they were registered. Okay. Business trust, InvIT and REIT, and the investment fund, the AIFs, are required to furnish return of income in all cases. Okay. Now we will come to the penal consequences. We left 272A penalty. Now we can cover it. It says if a person failed to furnish return of income required under section 104A. 4A means charitable organization or religious trust. Or 104C means that organization which were exempt under section 10. Trade union, news agencies, etc. etc. Within the due date, he shall pay a penalty of 500 per day to which the failure continues. So huge penalty. So if charitable organization or this section 10 organization doesn't file return of income within time, then the penalty is 500 rupees per day. In any other case, there's a fee of 5,000, 1,000. But here, the lump sum fee. But here, 500 rupees per day, during which the failure continues. Okay. So if you see, the penalty for charitable registers is 234F. They have to pay fee in any case. 234A, of course, interest, and rupees 500. It is 500 per day, 272A. Sorry. For political party, there is no 272A. 272 is applicable only for 4A and 4C. So political party same, 234F and 234A. But for again, organization exempt section 10, 234F, 234A and 272A. Hope I'm clear? Okay. We can delete the stuff. Now, before, still, we will, okay, there's some boring portion. Before that, let's do some MCQ. It will create an interest in you. We have done 2 MCQs. Let's start with the third. So it says, which of the following person is not required to file return of income for AY 26-27? You have to tell which of the person is not required to furnish return of income. Let's see who tells first. A company which was incorporated on 31st March 26 and did not have any income during the year, he has to file because it's a company for incorporated on 30th March. A LLP incurred a loss of 3 lakh during the year. He has to file the return of income because a company or firm are required to furnish return of income in all cases. A business trust having nil income, again, have to file return of income because university association or other association under section 35, business trust and investment fund. They also are required to furnish return of income in all cases. D. All of the above are required to furnish income. Yeah. The answer is very much apparent, but I hope you have applied your mind. Okay, I believe in you. 4. State which of the following statement is correct. An institution referred to in section 35 is required to furnish return of income only if its gross received exceeds the maximum not chargeable tax. No. It is required to furnish return of income in all cases. Option D will not come. Geeta, are you asking this for question number 3 or question number 4?
No, sir, 3, because they ask not required to file return. So D will, how D will come?
Yeah, there is a small this language issue, but in all this, the most appropriate answer is the 4th one. Understood? We have to go with the most appropriate answer in case of MCQs. There would happen a case in your exam that the answer will not be very specific. In such case, you have to go with the most appropriate answer. So state which of the following is correct. So first is not correct because section 35 organizations are required to furnish return of income in all cases. An investment fund referred to in section 115 UB is always required to furnish his return of income irrespective of the amount of his income. Yes, it has to furnish return of income. This is correct. A HUF being a resident, ordinary resident having a gross total income of 2 lakh is required to furnish return of income if it owns the asset outside India. Now tell me why not C. HUF is ROR, though its income is less than basic assumption limit, but it has an asset outside India. So, is our HUF not covered by that clause? Yeah, perfect, Yogesh. I told you the interpretation. The main section says person, any person who is ROR is required to furnish. But if you go deep, if you see the meaning of beneficiary, owner and beneficiary, they are linked to only the individuals. So, by interpretation, we came to the conclusion that this section, this clause applicable is only case of individual. So answer is B. Which of the following person required to furnish return of income? A mutual fund who claimed exemption of rupees 1 crore under section 1023D So they are those 139 4C. They are required to furnish return of income. A business trust having GTI of 75,000, irrespective of the GTI, even if case of nil, it has to file the return of income. A political party having total income of nil after claiming exemption of 5 lakh under section 13A, yes, it has to furnish a return of income. And all of them. Yes, all of them. Answer me. Had it been the case of 50,000. So in part C, if the question says a political party have a total income of nil after claiming exemption of rupees 50,000, would in such case political party would be required to furnish return of income? No, of course no. Perfect. Why? Because I have to see the income before exemption should exceed basic exemption limit. Even the income before exemption is 50,000, they are not required. Okay. I am required to furnish return of income in all cases only in respect of these three entities. Section 35 wali, then there's business trust and investment fund. But for charitable organization, for political party and section 10 exemptions entities, at least the gross income before the exemption should exceed the basic exemption limit. See, this was September 25 2 months, but we have not yet covered this. I'll do one more question. This is a study math question. State with reason whether the return of income is to be filed in the following cases for assessment year 26-27. You have to say whether the return of income is required to be furnished or not. Mr. X, a resident individual aged 80 years, has a total income of 2,85,000. He has claimed deduction of 1,50,000 under section 80C. Long-term capital gain of 80,000 not taxable by virtue of exemption available up to specified threshold under section 112A. Assume that he has opted for the normal provision of Income Tax Act. Tell me whether he is required to furnish return of income or not. What you have to see? You have to see the GTI before section 54 exemption. 2,85,000 is my TI, total income. This deduction has 1,50,000 has already been deducted while computing this 2,85,000. So my GTI would have been 2,85,000 plus 1,50,000. 4,35,000. I am a person of 80 years of age. So my assumption limit under the old regime, I have opted for normal provisions. I am asking about the old regime. My basic assumption limit is 5 lakh. And my GTI before section 54 exemption is 4,35,000. I am not required. Yogesh has said no. But we have not considered this 80,000 anywhere. What we will do with this 80,000? So this 80,000, though not taxable, but it must have been a part of this 2,85,000. It will become a part of your total income, though it's exempt under section 112A up to a specified limit of 1,25,000. You understand? Okay. No, Geeta, if I add capital gain to 2,85,000, 1,50,000 plus 80,000, then the amount comes 5,15,000, which exceeds the basic exemption limit. But you see, I have to add not the capital gain, I have to add the exemption under section 54. This 80,000 is not the exemption under 54. It's the capital gain, which is otherwise not taxable under section 112A, because 112A gives a threshold of 1,25,000. So capital gain on listed shares is not taxable up to 1,25,000. Okay, so you got it now. So this 80,000 must have been included in 2,85,000, and it should be. So it's being already included, therefore we are not again adding it. Okay. Would your answer change if Mr. X has incurred 1,05,000 towards payment of electricity bill for financial year 25-26? Yes. In such case, he has to file a return of income because the electricity expenditure exceeds rupees 1 lakh. Okay. ABC, a partnership firm, has a loss of 10,000 during the previous year, 25-26. Still, he has to file the return of income. Whether loss or income not relevant, a firm is mandatory required to furnish return of income. A registered association eligible for exemption section 1023B, section 10 exemption, has income from house property of 6,60,000. Even though the entire income is exempt under section 1023B, still before exemption the income exceeds the exemption limit, therefore the association is required to furnish return of income. Lastly, Mr. Y, aged 45 years, an employee of ABC Private Limited, draws a salary of 5,90,000 and has income from fixed deposit with bank of rupees 10,000. So he has a salary of 590 and has income from fixed deposit 10,000. Is he required to furnish return of income? So, okay, Yogesh is saying yes. Yogesh, can you tell me why? Yes, above exemption. So what is the amount which we are considering the above exemption? Are we seeing 5,90,000 plus 10,000? No, I understood the exemption is 3 lakh. But where is the 3 lakh coming from? It's not a 3 lakh actually. It's either 2.5 lakh or 4 lakh. Under the old regime it's 2.5 lakh or under the new regime it's 4 lakh. Okay. But I'm asking which amount you are comparing with the basic exemption limit. Are you comparing 6 lakh? 590 plus 10? When I'm saying that I'm required to furnish return of income because good, perfect. Yogesh said 590 minus 75 plus 2. So I have to allow the standard deduction under salary. See, here the marks loses. The student, what he does is, he says that he is required to furnish return of income. Yes, because of course, by seeing 5,90,000, anybody would say that he is required to furnish return of income, then the GTI would exceed the basic exemption limit. But there would be marks. You know, there is a stepwise marking in the ICAI exams. There will definitely be marks to compute this amount. 590 minus 75 plus 10,000 means 5,25,000. There will be half of 1 mark be assigned that what amount you have computed to compare with the basic exemption limit. So you have to be, this is what happens when the student says that my answer was right, but mark is not given. It is not given because of these reasons. As we go on, I'll try to explain you more how to attempt the paper and all. Okay. Now we'll come back to our topic. So earlier we studied who all are required to furnish return of income, even though not required in section 139(1). Now we will study who all are exempted from filing return of income. We are not talking about the person whose income is less than the basic exemption limit. We are talking about the person who may have income more than basic exemption limit, but they are specifically exempted from the filing return of income. Before coming to that, a question should come, why would government exempt a person? Because there will be a revenue loss. If you exempt a person from filing return of income, that person will not pay the tax. The tax is paid as part of filing return of income. Understood? So, one thing is certain, in all these cases, either there is an income, but that income is not taxable, or means there is no tax liability, or whatever there is a tax liability, that tax liability has already been discharged, has already been paid, and the government has received the tax liability. So generally these exemptions are provided to the non-resident because we want to invite non-resident and we say that we are less compliant, there will not be much compliance issue. So wherever possible, the government makes the life easy for the non-residents. So exemptions are provided for the non-resident, but not at the cost of loss of tax revenue. You will see in all these cases, either the income is not taxable, so there is no tax liability at all, no loss to the government, or the whatever tax liability, it has already been discharged by way of TDS. Okay. So who all are the assessee? Assessee is a non-resident or a foreign company What type of income he is driving? He is driving income from investment fund located in IFSC in India. Investment fund means AIF, alternate investment fund, category 1 and 2. So what are the conditions? If this condition is satisfied, then this person is not required to furnish return of income. Condition is tax under section 194 LBB has been deducted at source and remitted to the central government by investment fund. So under section 194 LBB, the tax rate is the same rate, the TDS rate is the same rate on which the income is taxable in the hand of recipient. So the TDS rate under section 194 LBB is the same on which the foreign company or the non-resident was required to pay to the government. So the same amount, the actual amount has already been deducted and remitted to the central government. In such case, the government has exempted them to file return of income because there is no law. But there has to be no other income. Had there been other income, then there will be revenue loss for the government, and then government will not allow the exemption. Okay. So first thing, whatever tax liability was there was deducted by the deductor. There is no other income, and no notice has been issued to these entities. And so once no notice has been issued, therefore this entity is exempt. We study all these notices in the next class. Again, exemption provided to NR or foreign company if income from investment specified fund referred to in section 1040. So this is income exempt. There is no other income, and provision section 139 AA, which is PAN, are not applicable. So even they are exempt from the PAN as well. We will study in a minute. A non-resident being an eligible foreign investor, what income he is driving? He is driving income of capital gain, which is exempt under section 47. Okay, 7AB. So what is transferring the capital asset? What capital asset transferring is? He is transferring bond or GDR under section 115 AC, or rupee denominated bond of Indian company, derivative of other notified securities. On transfer of this asset, this transfer is not considered as a transfer in section 47, and therefore no capital gain arises. If this NR has only this income, then he is exempted for filing return of income. Even these persons, 6 lakh, got it. Good now. Okay. Even, yes, anything? Even these persons are exempted from the requirement of obtaining PAN number. But in such case, they have to furnish some basic details, KYC types. Above person not required to obtain PAN if he furnish the following details and document respectively to the specified fund stockbroker. So which details are? Name, email ID and contact number, of course. Address of the country in which he is resident. If he is a resident of a foreign country, of course they are NR in a foreign company, they are resident of a foreign company. So the address in such country. A declaration that he is a resident of a country outside India. A declaration that he is not a resident of India, is a resident of a country outside India. And tax identification number or any unique number in the country of his residence. Like in India, we have a PAN number. Anything similar to PAN in their country of residence, they have to supply. So that in future, the government can get hold of that if they run away. If in future we find that they have other income or something like that. So we have all the information. So if you provide all this information, then you are not required to obtain the PAN as well, and you are not required to furnish the return of income as. Okay. This list is not exhaustive. In various sections of the Income Tax Act, the individual section exempt the specific person dealt therein from the requirement of furnish return of income. If you remember, there is section 115A, which applies on provide a tax rate on interest, dividend, royalty, and fee for technical service derived by received by a foreign company or non-resident from India. So this section 115A says that if tax has been deducted under the Act on these income, then the foreign company is not required to furnish return of income if it has no other income. No. If you remember, there is a section 194P. It applies on specified senior citizen. It says that if the bank has deducted tax of such specified senior citizen, then such specified senior citizen is not required to furnish return of income. So if the question comes, who all are not required to furnish return of income? Then you have many such, you can put these 3 points, then 115A, 194P. You can even write any person whose income is less than basic assumption limit and doesn't fall under the 7th clause. Yeah. 194E, yes. So there are different sections which gives exemptions. We're not dealing with that. We'll deal with that at the time when we study those sections. This was only just to clear on that. Okay. Now we will do some two, three topics which are not very much important from exam point of view, but we'll cover it. Examiner may ask. See, what happened in C exam is that there are two types of questions asked in the exam. One is application based and one is knowledge based. Application based are major parts. They are very limited. Knowledge based means shorter question. They ask you that question. You have to put the provision. So in case of knowledge based question, these type of questions are generally asked. Who is TRP? Well, TRP is, there is a scheme of the CBDT, Center Board of Direct Taxes, which authorizes person to act as tax return preparer. They help the public at large to furnish the return of income. So CBDT gives a certificate to them and authorizes them that they can help the people to furnish their return of income. But every person cannot be a TRP. Who can be a TRP? Only individual can be a TRP. Okay. But who holds a bachelor degree from a recognized Indian university or institution, who is a graduate, or who has passed intermediate level examination conducted by ICAI's company secretary or cost accountant. So if any person is inter pass, then he can become a TRP. Who cannot be a TRP? Now, there we say what is the requirement to become a TRP? But these are the person who cannot become a TRP. Who? Any officer of a scheduled bank with the assessee maintains a current account or has other regulatory. If you are an employee of a bank which with the assessee has a current account, then you cannot file the return of such assessee as a TRP. Any legal practitioner, lawyer, who is entitled to practice in civil court, they cannot become a TRP. Chartered accountants, we cannot become a TRP. An employee of an eligible assessee. You as a TRP cannot file the return of your own employer. Okay. So we saw who can be TRP or who cannot be a TRP. Okay. Now we will see who all are people who can get the return filed through TRP and who all are people who cannot get the return filed through TRP. In the same thing. So we will call them eligible assessee. Means assessee who can get the return filed through TRP. Who can be eligible assessee who can get their return filed through TRP? Any person being an individual or HUF. So only individual HUF can get their return filed through TRP. Company, firm, etc. cannot get their return filed through TRP. Who cannot be eligible assessee? This person cannot get their return filed through TRP. An individual HUF whose accounts of business or profession are required to be audited in section 44AB or under any other law for the time being force. If your accounts are required to be audited, then you cannot file it on a TRP. You need a chartered accountant, a professional. Good for us. An individual HUF who is not resident in India during the previous year. So, TRP cannot file a return of income of non-resident. Understood? A small theoretical provision. One more theoretical provision we have. Yeah. This say particulars to be furnished with return of income. Again, a very theoretical provision. As I told you, now we have a digital return, system, computerized return. It does not allow you to move ahead unless you furnish all the required mandatory information. These provisions were much relevant when there was a manual return used to be filed. So what it says from exam point of view, for all the assessees, you have to furnish the detail of your exempt income. If you're an agricultural income, you have to furnish the details. What is the amount of agricultural income? What is the area of agricultural land you have? where you have agriculture and all the details are asked in the written form. Expenditure income the prescribed had exceeding the prescribed limit. Any other outgoing as may prescribe. Asset of the prescribed nature and value held by him as beneficial owner or otherwise, or in which he is beneficiary. You can relate all these points. Bank account and credit card held by him. So all the detail has been asked in the written form. If you are engaged in the business profession, then you have to furnish tax audit report. Otherwise, return shall be deemed as a defective. The particulars of location, style of principal business, principal place of business or profession, and all the branches thereof. Particulars and location and style means you need to provide the address of this, where is your principal place of business, and address of all the branches. Name and address of his partners, if any, in such business or profession. If you are a partner in a partnership firm, then you have to provide the name of all other partners as well. If he is a member of AOPBY, names of other member to the extent of share of profit and their profit sharing ratio as well. Okay. Now we'll come to self-assessment tax. A very small topic and an interesting one. We have already discussed this in last 1 or 2 hours. This is what? This is nothing with a tax payable at the time of filing return of income. If you remember, there is question number 1 in your exam, which is comprehensive question, which asks you to determine the total income and compute the tax liability. Right? It's the obvious first question. Compulsory question. There we discuss if the question asks tax liability, then you have to compute the tax payable without giving a deduction of TDS and TCS. But if question asks give the tax payable amount, then you have to compute the tax liability, reduce the TDS, TCS, advance, or anything, whatever is there in the question, and you will compute tax payable. This tax payable is nothing but the self-assessment test. Assessee is required to pay self-assessment tax computed as under before filing return of income. Tax computed on the return of income, this is my tax liability. Understood? But this is not payable by me because a part of it I have already paid. How? By way of advance tax, by way of TDS, TCS. I may got some relief under section 89 or foreign tax credit in section 90, 90 and 91 or MAT or AMT credit. The remaining amount is only payable by me, and this is called self-assessment tax. But on this amount, I need to apply interest, which we will study under the interest chapter 234A, B, and C. We have briefly discussed 234A, not practically. We understood the provision, but we have not done the practical questions. This we will do in the interest chapter. Plus fee. So when I file a return of income, I pay 3 things. I pay tax due after all this TDS and TCS. Plus I pay interest. Plus I pay fee. This fee is 234F, 5,000, 1,000 as the case may be. It's not mandatory that I have to pay all this. It depends upon the situation. Okay. There may be a different situation as well. Assessee shall be liable to pay self-assessment tax together with interest and fee, if any. Return shall be accompanied by the proof of payment of such tax, interest, and fee. So, no proof is attached, only the details or the particulars of the payment is furnished. If assessee fails to pay the whole of such tax, if, say, the amount payable was, aggregated amount of all these 3 is, say, 2 lakh. But I pay only 1,50,000. So, I fail to pay the entire amount. Then he shall be deemed to be assessee in default in respect of such tax, interest, or fee remaining unpaid. So I will be deemed as assessee in default in respect of rupees 50,000. There is interest and penalty for being assessee in default under section 220 and 221. Where the amount paid by assessee falls short, like here, of the aggregate of tax, interest, and fee, the amount so paid shall first be adjusted towards the fee. So out of this 1,50,000 which I have paid, first it will deem that I have paid the fees. The balance would be adjusted towards the interest, and the remaining, if any, shall be adjusted towards the tax. So, if I short pay the tax, the amount, then first the amount which has been paid shall be adjusted towards the fee, then interest, and lastly towards the tax. Clear? In case of any difficulty in understanding, let me know. We'll work on this. Now, all attention. We are doing the most important topic of this chapter, the updated data. There is amendment also in this section, in this topic. So therefore, it's important from exam point of view as well. What is an updated data? I tell you, first we understand the concept. All eyes on me. Okay. So what happened is that in last 5 to 10 years, the India has become a very digital economy. Now the government is getting a lot of information about each person. So government knows about you more than you know that government knows about you. Yeah. So whatever you think the government knows, but government knows more than that about you. In your CA forms, at the time of articles, you must have experienced whenever the assessee comes, we ask for filing of return of income. We ask the details of his return, if his income. The normal answer is there is no income. I have not earned anything. I only have the salary of this much. But now, I once logged in on his portal, who is PAN, got all the information. Even he feels surprised. How do you know that I have this income? Because everything is visible, everything is reflected on the portal. And how this information is getting reflected on the portal? Because now PAN, Aadhaar, everything is linked. So whatever transaction, money transaction you are undertaking is getting recorded somewhere, and it's getting processed, and the income tax department is getting aware about such transaction, and they inform you as well that we know this. Kindly consider this. I tell you, even the government doesn't want litigation. See, there is always a cost of litigation, not only for the assessee, but for the government as well. Government has to incur a lot of expenditure on the entire machinery for the litigation. They have to do the assessment, then the appeals, then the court cases, tribunal court, the revenue, the amount get blocked. Government doesn't get the amount till the case ultimately settled. And there's a whole cost for all this machinery. Even government doesn't want litigation. But at the same time, government doesn't want to lose the revenue also. Not on the fear of litigation, I will not lose my revenue. So what does government come up? Government said that I have information about you. You have filed your return of income, and I know you have not considered such information in your return of income. It means you have concealed your income. I know that. Government knows that. But I don't want to, I can do the assessment as well and assess you, levy interest, levy penalty and all things. But it will involve cost for me as well. So I will give you one more chance. What government does is that government said, nowadays what government does, it gives the notices. It gives the, I have this information and it seems that you have not considered in your return of income. Kindly see. So there's no assessment notice. It's only information that we have something about you. If you want to disclose, you may. But by the time this letter comes, the due date for furnishing revised return expires. It's very limited, 31st December. Okay. So what the government does, government brings out the concept of updated return. You can file an updated return. You can update your return up to 4 years from the end of relevant assessment year. So 5 years from the previous year. So my relevant assessment year is 26-27. For 26-27, I can file my updated return up to 31st March 2031. My assessment year ends on 31st March 27, 4 years from that date. So 31st March 31, I can file my update return. Earlier it was 2 years. In the Finance Act 2025, it was increased to the 4 years. Okay. But see, I told you, there is some specific word which has a specific meaning. So updated return means updated return in section 139A. You cannot use revised return, modified return, change return, amended return, and any other word. Updated return means updated return. Okay. So, but government say, I am giving you 4 years for filing an updated return. But this 4 years is for my benefit. You cannot file updated return for your benefit. So there has to be something payable in the updated return. This is only for the benefit of government. So what does this? Again, one more thing. This benefit is not free of cost. They will charge some extra amount for filing an updated return. We'll go in detail. Generally, two types of question can be asked in this case. First, in what scenarios the updated return can be filed? So either they will give you the facts and ask you whether you can file the updated return or not, or a theory question, in what scenarios an updated return cannot be filed. Or second type of question may be, they will ask you to compute the amount which is to be payable at the time of filing updated return. Okay. Let's see. We'll go slowly on this and we'll discuss in detail. Any person may furnish an updated return within 48 months from the end of revenue assessment year. Okay. One point is that there is no requirement to whether you have furnished the original return in time or belated, anything. Whether you have or you have not, you are eligible to furnish updated return. It's not relevant whether you have furnished an updated return or not. Or you have furnished the original return or not. You can file the updated return. So any person may furnish updated return, but there is a time limit which is 48 months from the end of revenue assessment year. The updated return can be filed whether or not assessee have furnished the earlier return for such assessment year. Understood? So whether I have filed the return under section 101 or 104, original return or belated return, or whether I have not filed the return of income, 109 or 104, irrespective of case, I can file my updated return. The updated return shall be deemed to be defective if it is not accompanied by the proof of payment of tax as required under section 140B. So I told you there is something payable. There will have to be something payable in updated return. Okay. So it says 139 defective return. If that amount is not paid at the time of filing of return of income, the updated return shall be deemed to be defective. If you remember, the similar provision was not there for original return. Even in case of original return, I am required to pay self-assessment tax under section 140A. But if I don't pay my self-assessment tax under section 140A, then my return is not considered defective. It's not defective. Under the clauses of defective, this was not there that the return should be accompanied by the payment of tax. Rather, it gives me the provision. If I not pay, then what will happen? I will be deemed to be assessed in default and all. But in case of updated return, if whatever amount is due, I have not paid that amount, then my return will be deemed to be defective. Interest under section 234A, B, and C shall be computed with reference to tax declared in the updated return. So, as we know, interest is levied on the basis of the amount of tax which was due, which has not paid. In updated return, I have increased my income because, as I told you, I got that letter, I got the information, or for whatever reason, I feel that I have shown wrong income, I have shown lesser income, then I increased my income. And therefore, by increasing income, there would be increasing tax liability, and the interest would be computed on the revised tax liability, logical as well. Okay, before the fifth bullet, let's see when I cannot file the updated return. So law says that an updated return cannot be filed if the updated return is a return of loss. I cannot file a loss return as an updated return. I cannot show a loss in an updated return. The updated return has to be the return of income. It cannot be a return of loss. It's not allowed. But it can happen that in the original return, I filed loss. I showed loss. But in the updated return, I am converting that loss into the income. So my updated return is of an income. That's possible. I can convert my loss into income. But I cannot file a loss return as an updated return. But in such case, assuming for AY 26-27, I file my original return with a loss of rupees 2 lakh. Okay. Now, somewhere in say 31st March 30, I am filing an updated return for this year and I am converting this 2 lakh loss into a profit of rupees 5 lakh. I felt that I have concealed the income or some mistake have happened. I am updating my return with the income of 5 lakh. This is allowed. The updated return and income of income, this is allowed, no issue, fine. But a issue comes, it might happen that in the AY 27-28, I might have set off this loss against the income of AY 27-28. It might happen. So the law says, if you are converting your loss into an income, if you're reducing your loss, or if you are reducing the MAT or AMT credit in your updated return, then you're mandatorily required to update the return of subsequent year in which this loss or credit was utilized. Logical as well. Because when you're saying that I'm updating my loss into income, so there was never a loss. That's why you're substituting that loss with the income. So since there was never a loss, how can you adjust it subsequently? So that adjustment was wrong. Again, you have to update the income of subsequent year in which this adjustment has done and have to pay the tax in subsequent year as well. So this fifth bullet says, if loss, unabsorbed depreciation or tax credit carried forward is to be reduced from any subsequent previous year as a result of furnishing updated return of income for previous year, an updated return is required to be furnished for each the subsequent previous year. Understood? If such loss, depreciation or tax credit is carried forward is to be reduced for any subsequent previous year as a result of furnishing of updated return of income of previous year, the updated return is required to be furnished for each subsequent previous year. So in subsequent previous year, if I have adjusted this loss or credit, then I have to update the return of such subsequent year as well. Logical. Okay. What are other exceptions where I cannot file the updated return? See, a updated return cannot be return of loss. Say, in the original return, I claimed I filed a loss of rupees 2 lakh. Now, in updated return, I want to file a return loss of 1 lakh. I am reducing the loss. Even this is not allowed. Updated return cannot be a return of loss. Full stop. An updated return cannot be filed if updated return has the effect of decreasing the tax liability determined on the basis of earlier return furnished for such assessment year. Understood? As I told you, this updated return is only for the benefit of government. So if you're reducing your tax liability from the return earlier filed, then updated return is not valid return. Okay. In case you have not filed an updated return earlier, then you cannot claim the refund in the updated return. See next point. If an updated return is a result in refund or increases the refund due on the basis of earlier return furnished for such assessment year, then updated return cannot be filed. You have to just remember two things. One, a loss return cannot be updated return. Secondly, updated return is only for the benefit of government. So you cannot reduce your income tax liability. You cannot increase your refund. You cannot claim your refund in the updated return. Understood? Now it says an updated return cannot be filed for the revenue assessment year where an updated return has already been furnished for such assessment year. It means an updated return cannot be revised. You have only one opportunity to file an updated return. If you once file an updated return for an assessment year, you cannot again file an updated return for such assessment year. you will get only one opportunity. Secondly, any proceeding for assessment or reassessment is pending or has been completed for such assessment year. If any assessment has been initiated on you for such assessment year, then you cannot file an updated return for such assessment year. Understood? See, a similar clause was there in case of revised return and updated return. The time limit was 3 months prior to the end of regular assessment year or before completion of assessment. You could have revised your return. The words there were completion of assessment. But here is that any assessment is pending. So even the proceeding, even if I have started, then also you cannot file a revised, updated return. You can file a revised return if there is a time. If you have received assessment notice before 31st December assessment year, you can file a revised return. But you cannot file a updated return. Okay. Any prosecution proceeding have been initiated for such assessment year. So any assessment proceeding initiated, then you cannot file updated return. Then prosecution proceeding, of course, you cannot file. Okay. Then the law says, if the tax officer has received some information that from foreign country about the income you have conceived, any information about you from the foreign country, the section 90 or 90 here. What this section 90 or 90 says? This says that central government can enter into an agreement, which we say double taxation avoidance agreement, DTL. What is the purpose of DTL? There are two purposes. One is to give the relief from the double taxation, and second is to exchange information. So if the tax officer receives some information from the foreign government as an exchange of information about you, and he has intimated some information to you, then you cannot file updated return for such assessment year. So there has to be two conditions. The tax officer must have an information about you, which he has received under section 90 or 98. And most importantly, before filing your updated return, he must have communicated this information to you. Only in such case, you cannot file updated return for such assessment year. But if you file the updated return before such communication arrives you, then such return is valid return. Such return is invalid return only if you file the return once this communication arrived you. You have received this communication. So an information for such assessment has been received under section 90 or 90A, and same has been communicated to the assessee. So requirement is the information must have been communicated to the assessee as well. Next point is, AO has information in its possession for such assessment year under the Smuggler, Foreign Exchange, Manipular, Forfeiture Property Act, or Black Money Act, or Benami Property Act, or Money Laundering Act, and same has been communicated to assessee. So assessing officer received some information under these act against you, and he has also communicated this information to you. Then you cannot file the updated return once it's communicated for such assessment year. Or assessee belongs to such class of person as notified by SEBI. So there is no such notification as yet, who cannot file the updated return. There is one more clause. So in first clause we saw who are not required cannot file updated return is if the clause or it results in decrease of the income tax liability or increase of refund, then an updated return cannot be filed. Okay. In second case, are cases where it says that updated return cannot be revised. If assessment or prosecution proceeding even have started, even then you cannot file updated return. If assessing officer has some information either received from foreign country or under the Black Money Act, Benami Property Act, Money Laundering Act, and he has communicated that information to the assessee, then after such date, assessee cannot file updated return for such assessment year. Okay. Now we come to the third part of where it says that in case of search as well, I cannot file my updated return. But there's a difference. In case of search, In all above cases, I could not have filed updated return for the assessment year concerned. For the assessment year, in respect of which the tax office has the information about me. For other assessment, I couldn't have filed. But in case of such, I cannot file the updated return for such assessment year in which such has happened or any earlier assessment years. So once search has happened, my all earlier assessment years are forbidden, are blocked. I cannot file updated return for all those assessment years. Okay, so this is the unique thing in case of search only. You will keep it, remember, keep in mind. An updated return cannot be filed for assessment year relevant to the previous year in which search is initiated or service conducted or acquisition is made, and for any assessment year preceding such assessment year. Remember, and any assessment year preceding such assessment year. So under this clause, I cannot file the updated return for the assessment year in which such was happened and any preceding assessment year. This is something unique in this clause. For all other things, all other clauses were referring to the specific assessment year. But this clause is referring to the more than one assessment year. The assessment year in which search or service happened or any earlier assessment year. What is search? What is survey? What is the requisition? We all do this in next class when we do the search assessment. So you just read it for the time being. In next class, you will be able to appreciate. So updating cannot be filed if the search has been initiated in section 132. So if search has been done on my premises, I cannot file the updated return for such year or for any earlier previous year. Books of account of the document or any asset are requisitioned. I'll explain it. Where survey has been conducted under section 133A. So survey is a small baby of a search, you can say. Search is a bigger action, survey is a smaller action. We'll discuss this in detail when we'll do this. Where notice has been issued to the effect that any money, bullion, jewelry, or other valuable articles seized or acquisition under section 132 or 132 in case of any other person belong to such person, or any books of account documents seized or acquisition under section 132, 132A in case of any other person or pertain to or any other information contained therein related to such person. Such person means the assessee. If I tell you just, it would be difficult to retain in mind. What happens is that there are different ways of search. Tax officer may come to your premises and they search you. This is called normal search. Okay. Now what may happen? Maybe they find something which is not belonging to you but may be belonging to me. They may find some paper, some valuable article lying at your place which belongs to me. So it is deemed that I have also been searched. Okay. Another scenario may happen is that income tax department doesn't come to your premises. Say FEMA or ED came to you and they seized some documents. And income tax department now requisitions such document from the ED. So it is deemed that the income tax department has also searched you. Okay. So they are referring to all these things. Either a search has been initiated, means a direct search. The tax office has come to your premises. Books of account or other document others as acquisition means search has been conducted by some other authority, not the income tax authorities. And income tax authority has acquisition such document from those authorities. Or a survey has been conducted. In this case also, the tax officer visits your premises. Or what these points are saying, that search has happened, actual search has happened in the premises of some other person, but there the tax officer has found some document pertaining to the assessee. Where notice has been issued to the effect that a money, bullion, jewelry, other valuable article or thing seized or acquisition of section 132 or 132A in case of any other person belong to such person. Such person means belong to the assessee. Or any book of account or document seized or acquisition 132, 132A in case of any other person pertain to or any other information contained therein related to the assessee. Understood? So in all these cases, it is deemed that search has happened in your place and you are not allowed to file updated return for such year or any of the earlier year. Lastly, No updated return shall be furnished by any person where any notice under section 140A has been issued in his case after 36 months from the end of remuneration assessment. You put a dollar mark here. We will discuss this in the next class when we will do 148. Understood? So we'll conclude our class till now. In the next class, we will do how the amount is computed in the case of updated return and two small theoretical topic of PAN and Aadhaar. Then we'll shift to the assessment procedure. Till then, if you have any doubt, let me know. I'm here till 4-5 minutes. Now, I can stay if there is doubt. I'll wait for 4-5 minutes. If there is some doubt, then I come and we'll meet in the next class. Yes, Sanjay ji, I'll upload these notes, on the portal, on the ICAI portal. You can download it there, from there. I'll upload it today itself. Open to feedback. Anything you want to say, I'll be happy to improve on. Okay, so let's conclude for today. Let's meet again. Okay, so he's asking what is the amendment in the updated return which you were discussing. So I told you that we will discuss in the next class the amount which we need to pay with the updated return. So earlier I told you this, the updated return is not free of cost. The government is charging some fees. That fees depends upon the time by when you file the return. The more delay, the more fees. So if you file within one assessment year, say the assessment year 26-27, if you file by 31st March 28, then there is additional tax of 25%. We'll see in detail how this is computed. If you file by 29, then this comes to 50%. 30 goes to 60% and 31 70%. So earlier updated return was allowed to file only up to 2 years. So it was only 25%, 50%. But now the one amendment is that from 2 years it has increased to 4 years, 48 months. Earlier it was 24 months. So one amendment is that, and consequently, the additional tax rate has also increased. Okay. So let's meet again. Thank you. Thank you for the patient hearing. Yes, sir. Thank you.